It's just so difficult to determine what's going to happen next in this market.
If we continue to see this volatility, there likely will be long-term buying opportunities.
There is a big disconnect between the physical and the financial markets.
The risk aversion has been increasing dramatically.
At the end of the day, we have to ask ourselves the questions whether or not these positive trends can continue after the war.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, clinging to cautious optimism. The White House pushing a 15-point peace plan to end the war with Iran as plans are being made to increase the troop presence in the Middle East. It's leaving investors continuing to face down substantial two-way risk, heading into a weekend deadline.
This has been the issue. So many people have wanted to avoid missing out on the upward rip when there was some sort of capitulation or a sense of de-escalation. Question that an increasing number of investors are asking, are we reaching the point at which any kind of upside rally based on de-escalation is getting capped? We're sort of reaching the limits of how far that can go based on the fact that we are reaching real cannibalization from oil supplies and a real sense of destabilization in the region.
It's starting to appear in the data. So let's sit on the data. The stagflationary hit to the PMIs. So output a little bit lower, prices a little bit higher. You're starting to see it cascade through the economy. Asia first, and the Shell CEO saying Europe next.
Yeah, and we saw that in some of the PMIs coming out of Europe, and you see that with respect to what the ECB president is saying, which is essentially we will not hesitate to act, and this time does feel a little bit different in terms of the upside risk of inflation. There still is that downside risk, though, to growth, and that's what an increasing number of people are talking about. Larry Fink saying if this is not resolved and you get oil to $120 to $150 a barrel, brace yourself for a global recession.
Equity futures doing okay. No sign of a global recession here. Equity futures this morning positive by close to 1% on the S&P 500. Comfort again from a deeply backwardated futures curve. And the disconnect. How many times have you heard this line? The disconnect between the physical market and what is happening in the paper market and the futures curve.
So you could raise questions about whether this is some sort of manipulation, some sort of big trader coming from a variety of different places that have an incentive to lower the appearance of pain in the paper market, even as the physical market really experiences some real strain. On the other hand, there is a question of how low prices can go if this does continue, if there is demand destruction. Honestly, this remains to be a question. The Speaker of the Iranian parliament coming out and saying, well, right now it seems like they might be winning the war of words, but you can't print molecules, going back to what Jeff Curry had to say.
I think maybe he watched the Jeff Curry interview on this program.
It was pretty
just possibly
verbatim.
It's like word for word.
It was kind of shocking. I was thinking the exact same thing. I was like, hey, he's quoting Jeff Curry. Look at that.
Crude this morning down by close to 6% on Brent crude. Brent south of triple digits, 98.50 on Brent crude. WTI at about 87. Coming up on this program, we'll catch up with Martin Horne of Barings, with markets at the mercy of the headlines. Flexport CEO Ryan Petersen with global shipping upended by the war, and Francis Donald of RBC as inflationary pressures continue to increase. We begin this hour with our top story. The US sending Iran a 15-point plan to end the war. President Trump saying negotiations have begun. Bloomberg's Jumana Basechi joins us now from Dubai. Jumana, welcome to the program. So we've got a 15-point peace plan. What's Iran's response to it so far?
Well, nothing yet, John, and that's the critical question. What we understand, Bloomberg reporting overnight, is that the U.S. have sent their 15-point draft proposal to Iran, delivered via Pakistan. And much of the contents of the proposal are similar to the negotiating stance that the U.S. had even prior to the war, and some of those key elements on the nuclear deal, including that Iran should give up their plans to develop a nuclear weapon. They should dismantle some of their key centrifuges, limit their missile activity, stop funding proxies around the region. So none of that is new, but there is one new element per the draft proposal, which is Iran would have to commit to the full reopening of the strait without threats. And of course, as we've understood over the last couple of days, the strait is not closed. It is effectively being controlled by Iran still. And there's a letter that was being circulated by the International Maritime Organization overnight suggesting that Iran are allowing vessels to pass through so long as they deem them not to be hostile. So that is one part of the conversation. But I think what's key here is, number one, we don't know who exactly the U.S. is negotiating with. There has been no acknowledgement from Iran, at least from official voices, that direct negotiations are underway. There's been an offer to mediate from Pakistan, but still no official commentary And the second point here is, even if they are speaking to somebody, let's say one of these political figures, like the Speaker of the Parliament that Lisa just referenced, or Abbas Araghchi, the foreign minister, does that person actually have the clout and the influence to convince the hardliners in the IRGC and the clerics to actually sign on to some of the negotiating terms that the U.S. are putting forward? No doubt they, too, will be asking for very heavy concessions because they know that they have this leverage over the Strait of Hormuz now. So there's still a lot of daylight between the two sides and no official commentary coming through. I think there's some skepticism that diplomacy will actually lead to a positive outcome in the next couple of days. And that being said, look, it's still day 26 of this war. It's still ongoing. The operations are still ongoing. More strikes overnight. Israel hitting some key facilities around Iran. Iran striking back, yes, with a lower volume of projectiles than we had seen in the first couple of weeks, but they're still being very targeted about what they're hitting. Another fuel depot site hit near Kuwait. That disrupted some of the airline activity. More drones being intercepted in Saudi Arabia as well. So the war is still very much going on. Markets seem to be pricing in some form of a diplomatic breakthrough, but I think in this part of the world, there's some serious skepticism that this is actually going to yield anything tangible in the coming days.
Jemana, I appreciate the update. No doubt we'll hear from you a little bit later in the programme. Jemana Besetchi leading our coverage out of Dubai once again this morning. To Jemana's point, the economy's a mess right now in Iran, and power is very fragmented. So when we say we're negotiating with Iran, we have to keep on asking the question, who are you negotiating with, and is everybody on the right side?
Yeah, how much control does any given person have over the regime? You can also question, who's the we? Is it the U.S.? Is it Israel? Is it Saudi Arabia? Is it UAE? And is there a splintering of some of the parties involved?
Here's the view on Wall Street so far this morning. Martin Horne of Barings writing, geopolitical headlines typically have only short-lived effect on markets. We believe the inflationary bubble will likely be contained. Martin joins us now for more. Martin, welcome to the programme. Let's spend some time on that belief. What underpins that belief?
Well, when you've got two parties that are committing an act of mutual self-harm, generally speaking, those parties find a way to come together to find a conclusion. I think that's exactly what we're in. There's so much noise in the world. It's very difficult to be definitive around this. But you've seen fundamentally over many, many decades that geopolitical events, even the most tragic geopolitical events, the ones that shaped our history, have generally had a short-lived effect on financial markets, and then the markets pretty quickly revert to a position that is, okay, well, what's happened to interest rate policies? Where's inflation? Where's global growth? And of those three things, global growth is demonstrably at a low ebb, and this isn't going to be helpful to global growth. So I think markets will pretty quickly revert to the fact that commodity prices will adjust. But my core assumption there is that there will be a conclusion to this in a relatively discrete period of time. You and I could debate what discrete means.
Martin, we won't have that debate right now because ultimately we'll be back and forth all morning. I do want to talk about your faith, though, in the streams of earnings the US equities, US companies will generate in the next 12 months. That's where the faith seems to be stateside, and we see that in the equity market almost every single day. Earnings revisions aren't dramatically lower. In fact, in many cases, the outlook for earnings seems to be improving, which seems crazy. Martin, can you speak to that? What makes corporate America and that stream of earnings so resilient?
Well, at its core, you've still got a relatively good employment situation in America. At its core, you've got one of the economies that's investing the most significant amount in AI and AI generation. And let's face it, there's no point to AI if it doesn't produce an increased efficiency in the corporate landscape. And there's been a resilience now demonstrated by corporate earnings over the last 6 years. I mean, you think about it, we've had COVID, double-digit inflation, the largest rate rise you've seen in 30 years, various geopolitical events, the fundamental rewriting of trade lines across the planet. All of this should have produced a much, much dire situation, and it hasn't. And it hasn't because actually, when you look at it, I think corporates are appropriately geared for this marketplace. The management teams of corporates have generally been relatively conservative, because when would you have been bulled up? And they all see the necessity for AI adoption as a route to increased profitability, increased efficiency in the future. And they're all running at it, and some are running at it pretty hard.
I understand the earnings story, and a lot of people have pointed to that, Martin. How predicated, though, is the stock price performance aspect, predicated on the idea of central banks not hiking rates in response to the inflationary stress?
Look, I think it depends if you think about short term or long term. In the short term, I think we all know that if rates go into reverse, in particular in the US, you're going to get a market reaction, and you can just stand back and watch that happen. Again, in the longer term, do I think that rates will be elevated well above their current level for long? No, and I think when you listen to some of the narrative from Madame Lagarde earlier in the day, one of the things she pointed out was the rates in the European market were far more embedded around the neutral position, which was very, very different from 2022, was the point that she was making. I think in the US, arguably, rates are still slightly above the neutral position. And therefore, you've got latitude, I think, to bring rates down. That said, we live in a more inflationary world. Forget about the geopolitics of today. There's all sorts of dynamics that have changed over the last decade that mean I think we should be having a debate around whether 2% or 3% is a more relevant, stable picture. But I do believe that any rate rises will be followed by a kind of a movement back downwards, because what in the economy tells you that we're going to go up and up. I'm not a buyer of stagflation, as you can tell.
It strikes me, Martin, that you're incredibly optimistic relative to a lot of the people who I've been speaking with over the past 6-7 days, who seem much more concerned about even a de-escalation yielding a scenario where suddenly Iran controls one of the main waterways of the world, and energy prices and, frankly, commodity prices have to remain elevated for a longer period of time, creating stress that people are not recognizing but is being recognized in the physical market. What gives you confidence to be bullish at a time where so many people are raising some real structural concerns and saying the most dangerous words in finance? This time is different.
Yeah, listen, I've been in the credit markets for nearly 35 years. That makes me generically one of the most miserable people you'll ever meet. So I'm not often referred to as bullish. When you think about what I'm actually saying is, I think the world is in a pretty low growth environment right now, and I don't see that fundamentally changing. And I think to consider the rate policy will go into reverse. Do I think we're in structurally the same place as the 1970s when we last saw stagflation? No, I don't. I think the world is different, and I think the likelihood of stagflation is very, very limited. To be absolutely confident in light of changing dynamics that literally change by the hours, and you guys know that as much as anyone. No, you can't be that, and you've got to be flexible, and you've got to be flexible in your outlook, and you've got to be flexible in your thought process. But history tells us that there are some truths to these situations, including these situations generally get contained. It's not easy to see it when you're at the bottom of the pit and looking up, when you're in the heat of the moment. But these situations generally do get contained. We generally do revert to basic supply and demand dynamics around the world. We generally see rate policy and commodity pricing reflect that. And that's the core assumption here. I don't think it's too radical, but I'm sure that the news flow over the next 4 or 5 days might make us think again.
Martin, I've made a note. We'll never accuse you of being bullish again. OK? Martin, it's good to see you. Thank you, buddy. Martin Horne there of Barings, breaking down, I think, the consensus view where a lot of people are right now, looking down this shock. As for Lagarde, I read that speech earlier on this morning, said a lot without saying anything at all, almost perfectly neutral, which might be somewhat hawkish compared to where they were a few months ago, but relative to very hawkish market pricing, that was somewhat dovish. That's not an ECB that's in a rush to do anything anytime soon.
No, she wanted to say, I hear you, I see your feelings, I see you pricing in a rate hike. We're not doing anything right now. We remain open to the option of doing something later. Everyone, calm down. And that's essentially, the message that she's been saying for a while.
We're waiting for the data, and once we get it, then we can act. But it's too early to really draw any conclusions about where we are. So here's one scenario, and here's the other. That's kind of where a lot of central banks are at the moment. They can't say much more than that.
Which is a reason why you've got the likes of PIMCO saying right now this market is completely pricing wrongly how much these central banks are going to hike rates. And this continues to be the debate.
Futures this morning, positive by 0.8%, crude lower, bond yields down. Let's get you an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. The U.S. drafting a 15-point plan to end the war in Iran. Sources telling us here at Bloomberg the plan was delivered to Iran via Pakistan. The details of the proposal are unclear, but President Donald Trump has publicly said any agreement would have to include a prohibition on Iran ever obtaining a nuclear weapon. As the U.S. waits for Iran's response to that plan, it's also deploying about 2,000 soldiers to the Middle East. They will join about 5,000 Marines expected to arrive in the region this week. Sources telling us here at Bloomberg the troops could be tasked with a variety of support roles or participate in a ground attack, which could include seizing Karg Island. And no end in sight for the partial government shutdown that has led to long delays at the nation's airports. Senate Democrats rejecting the latest offer from Republicans to fund most of the Department of Homeland Security. Senate Democratic leader Chuck Schumer saying the GOP plan does not include any of the ICE policy reforms they've insisted on. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Do you want the Bramo travel review? What is it out of 10? How bad is it?
I have to be really honest. First of all, I sold out and I actually bought Clear, which I haven't done and I haven't wanted to do because I feel like it's pay to play. So I felt really bad about myself for having done that. But nonetheless, there was no line anywhere that I went. I think it's just certain chokeholds that have significant lines, but I did not experience
Which airport was this?
Either JFK at the time that I went, which was a very unpopular time, evidently, as well as LAX. I just didn't have a line.
Okay, there you go.
But that's, I'm not diminishing what other people experienced. That was just my personal experience.
This is your lived experience.
This is my lived experience.
There is value in that, and we appreciate it. It's good to have you back.
That.
Up next on the program, declaring victory.
We've won this. This war has been won. The leaders are all gone. Nobody knows who to talk to. But we're actually talking to the right people, and they want to make a deal so badly.
Up next, we'll catch up with the Flexport CEO, Ryan Petersen, from New York City this morning. Good morning. We are placing a lot of optimism in a diplomatic process that Iran denies it's engaging in. Setting the tone for the market this morning, crude lower, down by more than 5%. Brent a break of 198.63. That sets the tone for this. Equities higher on the S&P 500 and up across the board on the S&P up by 0.8% and bond yields lower. At the front end of the curve and across the curve. Two's down by 386 following a very sloppy 2-year auction in yesterday's session. I think a 5-year coming today, 7-year coming tomorrow.
Yeah, watch those auctions because that 2-year note auction, it was $69 billion of debt. Usually these are super sleepy. Nobody pays attention because they're incredibly easy. The bid to cover ratio, the lowest going back to 2024. Dealers forced to take up the most going back to 2022, igniting a sell-off. So people care about the auctions.
Even with a big repricing in yields higher as well, which is an interesting moment for fixed income. Under surveillance this morning, the focus on the diplomatic effort declaring victory.
We've won this. This war has been won. They have no Navy left. They have no Air Force left. They have no anti-aircraft equipment left. No radar left. No leaders left. The leaders are all gone. Nobody knows who to talk to. But we're actually talking to the right people, and they want to make a deal so badly.
So here's the latest this morning. The US delivering a 15-point plan to Iran that would bring an end to the war. Tehran yet to respond to the proposal and firing fresh attacks across the Gulf overnight. For more, Annmarie joins us from Washington. Morning, Annmarie.
Good morning, Jonathan. That's right. What we have is this administration potentially looking for this diplomatic off-ramp, and the Associated Press saying that via Pakistani officials, the Iranians have received this plan. But it's really unclear. And you hear that from the president even yesterday saying we're unclear of who is running the country. So it's unclear, Jonathan, who exactly in Washington is talking to who exactly in Tehran. And amidst all of this, we still have the Strait of Hormuz effectively shut, especially for Western allies, as the Iranians continue to control that key waterway. And that is the focus of this morning's conversation with Ryan Petersen of Flexport, of course, the global logistics company. He is here in Washington, D.C. He's a friend of the show. And I want to begin with a trip you made to the White House this week. You have been in discussions with this administration. What are they telling you about what is going on in terms of cargoes and shipping throughout these key waterways?
Yeah, thanks for having me on. Well, so actually a lot of our conversations are about tariffs, but I did get a little bit of insight into what's happening, especially with jet fuel, with the accessibility of fuel on the West Coast and in Alaska. That's been a major concern for the administration to make sure that these areas get fuel. And as you know, California shut down a lot of our refineries in California where I live. And so there's a real risk there because they don't have enough connectivity to the rest of America's energy infrastructure. So they waived the Jones Act. So the Jones Act is this act that says that for domestic ocean freight, so if you want to ship oil or refined products from Texas, other parts of the United States to California, or especially to Alaska, because Anchorage is such an important air freight airport, you can't do it on a foreign ship. That's what the Jones Act said. So the president waived the Jones Act to allow for these regions to get jet fuel from other parts of our country on non-U.S. made ships, which I think was a vital, there was a real fear that Anchorage Airport wouldn't have air freight. And a lot of people don't know this, but Anchorage is probably the most important cargo airport in the United States because cargo planes flying from Asia to the United States have to stop in Anchorage to refuel.
What are companies, your clients, telling you right now? Do they feel like some of the pressure is easing, or are things getting even more challenging?
No, it's definitely getting more and more challenging. I mean, the price of air freight especially has gone through the roof. If you're shipping from Asia to the United States, we're seeing prices have doubled since the beginning of the month, since the start of the conflict. Even that's carried over to the Asia to U.S. trade lanes where air freight prices have gone up a lot. Initially it was around a 60%. It kind of stabilized a little bit, but more like across all of the lanes, Asia to U.S. is up about 25%. So obviously you're going to hear about that, complaints about that. But actually the bigger problem is just available capacity. 20% of all the capacity in air cargo, it's actually 18% of the air cargo capacity in the world is operated by Middle Eastern airlines.
So it's been cut off.
Yeah, think Emirates, think Qatar Airways, Etihad. That probably includes Saudia, the Saudi airline. So that's a lot of capacity. It's effectively removed from the market. They've been operating limited flights. They've been trying to restore, but every time they come back, there's like another attack at the airport and they drop it again. So that's actually made it very difficult to get air freight moving at all in some cases. There's just not enough capacity.
I want to briefly end on the point you made about most of your conversation with the White House is about tariffs. About what exactly?
Yeah, well, we've been seeing a lot of tariff fraud. The United States allows foreign companies to import goods into the U.S. without having any nexus, think of an entity or an LLC or anything like that. Foreign companies can just import into the United States. I mean, so we've observed at Flexport a huge percentage of trade has flipped to where the Chinese companies are importing it with Chinese freight forwarders and under declaring the commercial invoice value, effectively cheating on their tariffs. So we've been calling attention to this and partnering with them on how they might enforce this. And so that was like a big agenda point for me, is sharing what we're seeing in the data, how this is happening, but also trying to learn what's going to happen with tariff refunds. As you know, the Supreme Court overturned the IEEPA tariffs. There's $166 billion that companies are owed. And CBP has said publicly that only 6% of companies have registered their bank account with the government to receive these refunds. So that's something that Flexport's been all over, trying to help companies get their refunds back when that process starts.
Ryan, thank you so much. Very insightful, especially off the heels of your conversations with the White House. Of course, Jonathan, that was Ryan Petersen of Flexport. He and his company really dealing with trifecta of issues. First, of course, it was COVID-19. Then, of course, it was tariffs and under the Biden administration, the issues in the Red Sea. And now it's the Strait of Hormuz.
Annmarie, appreciate the update. The shock of the last month or so, reducing capacity, the tariff volatility of the last 12 months, increase in friction. And overall, when you increase friction, you increase costs. It's making it more expensive to do business.
Yeah, and how much can some of these companies pass along those costs? That is going to be the key question during earnings season. How much do margins take a hit? How much do people's pocketbooks take a hit?
It's the key question for central banks as well. Up next on the programme, Dan Pickering of Pickering Energy Partners, with crude falling back into double digits. Plus, Yahira has your morning movers, travel stocks rallying in the pre-market. From New York, you're watching Bloomberg TV. Once again, as we've seen a few times already, many times over the last few weeks, crude setting the tone for financial markets more broadly. Brent crude down by 5%, WTI down by 5% also. The faith in the diplomatic process, the hope. How misplaced is that hope heading into the weekend? Substantial two-way risk still just lingering over this market. That's the price of crude this morning. Once you've seen that, you know what this looks like. Equities higher across the board. On the S&P 500 by 0.75%. The Nasdaq up by almost 1 percentage point. And in the bond market, 2-year, 10-year, 30-year yields down across the yield curve. We're down by 2 basis points on 2s. 10s down by 3. Look out for the auctions. The 2-year was really soft yesterday. Mentioned that just moments ago. 5-year supply coming later. 7-year supply coming tomorrow. I wanted to finish on this, though. Gold snapping a 9-day losing streak in yesterday's session, looking to build on yesterday's gains. This morning, higher by close to 2%. Gold, a really interesting story right now because central bank buying has been a major tailwind for this particular precious metal. Buying gold, buying gold, buying gold. And what do you do if you've been buying gold and you start to get in a bit of trouble? You sell it. And that's what some countries are starting to think about.
Yeah, whether it's the actual countries that are selling gold, whether it's the hedge funds that are selling gold to meet certain positions that have gotten stopped out. Had there been a 10th straight day of losses yesterday, it would have been an unprecedented run of declines for the precious metal. Again, this raises the question, how much is this positioning unwinds? How much are we reaching the end of that? And how much can this precious metal be the haven asset that is the hedge if this is how it responds in a time of turmoil?
Turkey. We put out the story this week that Turkey was considering selling its gold holdings, part of them anyway, to defend the Turkish lira. There is speculation about what Gulf nations will do with their gold reserves if they haven't got the oil revenue coming in the same way. It's question after question about who's going to monetize what and when.
Exactly, and at a time when everyone is looking to monetize at the same time. I think there is this extra element, too, that people keep talking about, which is that an increasing number of hedge funds and just average investors have used gold as the hedge instead of U.S. Treasuries, and suddenly there is a reassertion. There is the ultimate pain trade of buy U.S. assets once again coming back, upending some of the trades that people put on. Again, are we getting to a cleaner position now where suddenly people can start assessing exactly what the real value is? Or does this really undermine gold's proposition as what it is, which is a store of value?
Gold this morning higher by 1.8% as we count you down to the opening bell, 3 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing the travel stocks rising this morning. And no, it's not because Lisa finally got clear. All jokes aside, we are seeing the airlines and cruise lines rising as investors latch onto signs that the Iran situation may not be getting worse, at least for now. Now that we know that the U.S. has sent Iran this 15-point plan to try and resolve this conflict, helping to ease oil prices this morning, as you just said. And that goes a long way for the airline stocks, which had felt the brunt of this sell-off. Moving on to the chip stocks, we turn to ARM shares. They are rising 13% in the pre-market as the company moves to sell its own chips, moving beyond its traditional licensing model. And it's a big pivot for this company as it takes aim at the fast-growing data center market tied to AI. But that same demand is pushing supply to its limits. And for that reason, we are seeing other chip stocks like AMD and Intel rising this morning on reports from Nikkei warning customers about another round of price hikes for their CPUs. It's the latest sign that the chip shortage is moving beyond memory and into processors, and that is adding pressure for PC and server makers, smartphone makers as they compete with these data centers to try and get their chips. John?
Yahara, thank you. Thanks for the update. More from Yahara in about 10 minutes' time. On our radar this morning, the US sending around a 15-point peace plan to bring an end to the war. The details reportedly including sanctions relief, a rollback of Iran's nuclear program, and shipping access through the Strait of Hormuz. Elsewhere, the White House ordering the 82nd Airborne Division to deploy about 2,000 soldiers to the Middle East. Sources telling us here at Bloomberg the troops could take part in ground operations on Karg Island or occupy land along Iran's coast. And finally, travel disruptions continuing at U.S. airports across the nation as Senate Democrats reject an offer from President Trump to fund most of the DHS. United Airlines CEO Scott Kirby urging Congress to get the deal done.
There are places where we've had long lines. It's really the last week that it's started to increase a little bit. I am hopeful that we're near the finish line. I've been talking to folks in the Senate on both sides of the aisle. It does feel to me like we're close.
The hits keep coming for this industry. Kirby also warning airline ticket prices could increase up to 20%, Bramo, if jet fuel prices remain elevated.
So on the first point, I will just point out that in a February Gallup poll, the approval rating for Congress was 16%. That was down from more than 40% before the financial crisis in 2008. Just gives you a sense of how people feel about being held hostage in terms of the TSA agents when it comes to travel in order for Congress to get anything done. I'll leave that there. When it comes to fuel prices, there's a feeling right now that you have to game out some sort of bogey point if you're an airline, which is about a third of all costs of airlines are tied to oil prices. How do you do that at a time where things are moving so quickly? Scott Kirby, the CEO, is saying that prices will average above $100 a barrel through 2027, reach up to $175 at the peak, and that if they're going to offset the $11 billion of extra costs just where oil prices are now, ticket prices are going to have to go up 20%, and that will cannibalize from demand. He expects demand to fall off in response.
I've only got one question. Lie flat across 3 seats and I can buy them all at once. Have you seen this? Can you describe what United is unveiling and how much I'm going to have to pay? Because the question I had, and many people had the same question, do those 3 seats in coach cost the same amount as 1 seat in business? Or do I get to pay less to have the same amount of space?
Great questions. I'm sure will all be answered in time. What is notable to me, you look at the new planes. They smell like new planes. You walk in, it's very cool. The vast majority of the plane is premium seating. Only a small subset in the back is economy, is coach. And that, to me, tells you the path of travel for airlines, that premium is where they are going to make their money, and that is where they're going to put the dollars in terms of the plans for the planes. So even if you're not in premium, you can pretend to play premium if you just buy out all the seats and lie across.
Did you get to see the seats?
I did.
OK. And what's it look like? Did you lie across them? Is it comfortable?
I did not lie across them.
OK, you didn't try them out.
Have
we got any video of this? If we get some video of this, we'll play it later.
That'd be amazing. But, they look beautiful, and they're investing in these planes to try to cater to a higher-end kind of consumer. Interesting that they're doing this at a time of incredible volatility. And interesting that this comes after this has been where the primary income has come from. This is the K-shaped economy really demonstrating itself through the airline industry. Who can afford paying those seats? Who wants to pay for those seats? And how are these airlines going to keep going despite some of the volatility that we've been talking about?
If you haven't seen it, I'll try and describe it. Essentially, United is doing what we always wanted airlines to do, which is get rid of the armrests. You can pull them up and you can turn the 3 seats into a lie-flat bed, essentially, right? And you can share that with your family or just lie there alone.
Share that with your family?
Apparently.
Really? You could actually, I saw some people doing that yesterday.
Right, see? There you go.
I actually did witness this. The lie flat, it's a good...
We need to have a serious conversation, apparently, so let's do that right now. Let's talk about crude. Dipping below triple digits as the US sends Iran a peace plan, reportedly demanding shipping access through the Strait of Hormuz. Tehran currently charging select vessels as much as $2 million to pass. Dan Pickering of Pickering Energy Partners writing, time is not the threat of the US as the oil markets tighten every day with so much oil bottlenecked behind the strait. Dan joins us now for more. Dan, welcome to the programme. We've heard this a million times now over the past few weeks, that there is a massive disconnect between the physical market and paper markets. Can you briefly talk about that and maybe try and explain why that disconnect exists at the moment?
Sure, John. When you look at the demand for oil, particularly in the Middle East, oil and products, the spot market's very tight. Access is an issue. When you've got an access issue, prices are high. You look to the financial markets, Brent and TI, further removed, both in terms of paper barrels versus physical barrels, and further removed in terms of distance and that accessibility issue. So if you're in the U.S., record level of production here, 14 million barrels a day, biggest in the world. Less issues with access, prices are lower. Go to Europe, better paper barrels there, trading at a premium, closer to the conflict, but not in the conflict. Prices are higher than the U.S., lower than in Asia. So it's proximity and it's physical versus paper barrels.
And whoever's dependent on those physical barrels coming out of that region, Dan, you can see what's happening. Shortages are beginning to emerge. Can you help us track how the dominoes are falling at the moment? Where the shortages are appearing, in what product and where you think it's going to show up next?
You bet. If you look to Middle East, you look to Asia, what you're seeing is jet fuel, for instance, trading over $200 a barrel. You look at gasoline and oil trading in the $150 a barrel range. What you're starting to see in Asia, where accessibility is the issue, you're starting to see conservation measures, work from home initiatives, et cetera. So you're seeing price
start to impact demand in Asia because they're feeling the brunt of it immediately. That's the risk over time, is that availability issue spreads beyond just Asia, moves across the globe. And that's one of the reasons you're seeing this release from the strategic petroleum reserves across the world.
Dan, do you see a possibility for oil prices to go back to $65 or $75 a barrel if there is some de-escalation right now?
Yeah, if you open the straits, if barrels move through the straits, regardless of why, prices are going lower. We're trading WTI below 90 today. You'll go well below that if the straits open up. You will then move, so 65, 75 feels to me the landing point when things are back to normal. Hard to get to normal. What's normal look like on a go-forward basis? Is Iran in charge? If they are, there's going to be a risk premium that you've talked about on your program already this morning. So I think 65, 75 would be a logical landing point. If you snapped your fingers and everything went back to the way it was, that feels like a challenging outcome.
Some people are arguing, whether it's Morgan Stanley or Carlyle, that already there is a risk premium that needs to be baked into oil prices, even if there is some sort of de-escalation, because that new normal is so hard to put your finger on. Why do you disagree with a lot of these analysts saying that oil prices are never going back to that, and that, frankly, are stuck at these levels or above for the foreseeable future?
Yeah. Well, right now, the market's pricing in something like 10 or 15 million barrels a day offline. If that number comes down, I think price comes down. It doesn't go back to where it was. And the longer we go, and this I think is the key issue, we're burning up, 70 million barrels of inventory every week. If this stretches into, April and May, you're going to have a market that's, dramatically tightening, and you're putting consistently, every week means a higher floor. So right now, if we think things go to 65, 75, and this conflict lasts for 2 or 3 months, the 65, 75 goes up $10, $15, $20 a barrel. So that's, I think, where the more bullish folks are coming, is they're expecting this to last for a while. And if it does, prices will be higher, kind of painfully higher.
Dan, we talked a lot over here in New York about how insulated America is. They're not going to suffer from shortages because we produce close to 14 million barrels of crude per day. It's not quite true. It depends what state you're talking about. The average across the country right now for gasoline is about 4. For California, it's higher. And as you know, California is very dependent on importing refined product from abroad, from elsewhere. Dan, how are you tracking how things are building, and what kind of tension could we see in the coming weeks for California?
Yeah, California is in a pickle. Their policies have resulted in refineries shutting down, lack of production in the local market, reliance on imports. And so, the worse it gets in California, it's a big headline focus, and they are most at risk. They look more like Asia than anywhere in the U.S. And so, the easiest measure for all of us at home is just watching what gasoline prices do. And if U.S. prices nationally move from 4 to 5, which they would if this conflict continues, then I think you see California take even another step higher. So they've got a structural problem.
Yeah.
I don't think the U.S. is going to let it go crazy. But as the rest of the U.S. ratchets up, so will California.
Hey, Dan, it's good to see you. Thanks for making time for us. Dan Pickering there of Pickering Energy Partners. It is true that America's net position with energy is decent, fantastic. It's better than most compared to, say, Asia. But to Dan's point there, California looks a lot more like Asia. State by state, the story is radically different.
Yeah, in California, incredibly vulnerable, both from their own policies that have restricted some domestic or local production, I should say, as well as just the imports from Asia. I wonder what this does politically with Gavin Newsom potentially being the Democratic nominee.
Well, I think he's trying to blame what's happening in the White House for what's taking place right now.
Well, we get to talk about it for a couple more years. It'll be really fun.
Like the situation in California, how many times has Chevron talked about this? And Chevron again overnight warning about what could happen in that state and how vulnerable they are to this situation. Just to go back over that line again, California is more like Asia when it comes to energy, even though you've got this massive resource sitting in this country. they're not taking advantage of it.
Yeah, there's been a real effort to move away from fossil fuels, and that has been translated into much higher prices at the pump, just regardless of any kind of base increase, but also an increase in exports from elsewhere rather than domestic production.
Crude this morning negative by close to 5%, 87 on WTI. Brent crude at about 99, with an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The Strait of Hormuz beginning to reopen. Iran saying foreign ships can cross the strait as long as they aren't supporting acts of aggression against the country. Sources telling us here at Bloomberg, Tehran is charging transit fees on some commercial vessels passing through the strait. And as you all were just discussing, Chevron is warning that California is heading toward an energy crisis because of the Iran war and says state officials should declare an emergency. The company says it may quit refining oil in California within a decade unless officials roll back taxes and regulations. Now the latest on the investigation into the deadly crash at New York's LaGuardia Airport, a system designed to help air traffic controllers monitor vehicles and planes on the ground failed to alert personnel before a jet collided with a fire truck on the runway. The truck wasn't equipped with a transponder that would have helped pinpoint its exact location. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for that update. Appreciate it. Up next on the programme, withstanding the shock.
We'll really start to see that energy price shock feeding through in the March data. But really what matters is the persistence of that shock. We've taken up our expectations for headline inflation by around 50 basis points.
Up next, we'll catch up with the brilliant Francis Donald of RBC from New York City. You're watching Bloomberg TV. Stocks are positive this morning, higher by 0.8% on the S&P 500, setting the tone for that. This move in crude, Brent and WTI. Brent lower, WTI lower, down by more than 4%. A break of 100, back into double digits on Brent crude, 98.84. Unlocking some gains in the bond market and lower yields, down by about 3 basis points on 2s, 3.87 on 10s, down 3 also to 4.33. Under surveillance this morning, withstanding the shock.
We'll really start to see that energy price shock feeding through in the March data. We've taken up our expectations for headline inflation by around 50 basis points so far off the back of the energy price shock. I think the key thing to watch in terms of thinking about the feed through into inflation is not where the oil price is today, but really what matters is the persistence of that shock.
So here's the latest this morning. Economic impacts of the Iran war mounting, with average gasoline prices in the US nearing $4 per gallon. Global central banks weighing potential rate hikes, with inflation not expected to fall to target levels. Joining us now to discuss, Francis Donald of RBC. Francis, can we just begin with your outlook, your base case before this war, and whether it's changed at all looking out 12 months?
Our base case before this war was something that looked a lot like stagflation-like growth that was slightly below comfort level and inflation that was slightly above comfort level, importantly driven by services inflation. Our outlook now is maybe stagflation medium, so more weighing on growth and more upside to inflation. Now, these are not massive figures. We're looking at 3+-ish inflation, still high ones on growth, but it's not as comfortable as we would have liked. It certainly negates the tailwind coming from government spending, and inflation is probably going to lap itself again. I suspect next March we'll be celebrating the 6-year anniversary of inflation above that 2% target. So same directions and the wrong directions for this economy.
Let's go with your medium-grade stagflation. Francis, if we get medium-grade stagflation, how does this Federal Reserve respond? How much space do they have?
They don't have space. Monetary policy is not the right tool for what ails the U.S. economy. And let's be clear, the U.S. economy is not close to a recession. The unemployment rate is going to stay very low for supply side reasons, lack of workers in the American economy rather than lack of demand going forward. And there's nothing the Federal Reserve can do. They can hike or cut all they want. It's not going to open the Strait of Hormuz. We are once again in a supply shock that limits the abilities of central banks to deal with what needs help in the U.S. economy or any economy across the world. This is why we are increasingly leaning on fiscal policy. This is why government spending gets bigger and bigger. This is why the long end starts to rise. It's the same type of shock of a different flavor, unfortunately.
So we were talking about the fiscal lever, and a lot of people are looking at that and wondering, are we really going to foot the bill for it? Yesterday, we saw a pretty messy 2-year bond auction. Today, we've got 5-year. Tomorrow, we have 7-year notes being sold by the U.S. Treasury. How much are you getting concerned about buying government debt at these levels, given the concern about how much that fiscal lever will be pulled on?
Well, what I'm concerned about is more long run with U.S. fiscal position, which is we have rising pressures on Social Security coming through. Interest costs are also rising. Defense costs are high. And again, this is not a uniquely U.S. situation. We see this in developed markets across the entire world. So leaving or having to rely on the fiscal lever necessitates big government, and big government becoming the new norm going forward. And again, it's not just a U.S. issue. It's a new global macro factor. We have to switch our minds away from monetary policy being the cyclical driver towards governments and fiscal being the cyclical driver. The problem is that fiscal levers or governments tend to be more politically motivated. So your cycle becomes more attached to the political cycle as opposed to the economic one.
How much does your outlook change should this conflict go on in the Middle East for a longer period of time? In other words, you're talking about stagflation light going to stagflation medium. The rest of the world is talking about runaway growth or recession, and there's nothing in between, depending on whether there's de-escalation or not. How do you look at an ongoing, prolonged closure of the Strait of Hormuz and conflict in Iran as pressuring stagflation medium?
It's very uneven. And this is one of the challenges with a shock of this magnitude. Of course, we have net exporters of energy. So the United States, Canada, where GDP doesn't get impacted on the top line to the same amount. And then you have net importers. Your net exporters, like the United States or Canada, for example, they're dealing with predominantly a price shock. That's one type of shock. But your net importers, well, they're dealing with a price shock and a supply shock. That's a whole different ballgame than just an inflationary element that's being on top of what the US and Canada are currently facing. Underneath the surface, we also know it's an incredibly uneven shock for consumers. So on average, Americans, for example, spend less than 2% of all of what they spend on gasoline, but it's more near 4% for the bottom half of Americans. And so what concerns me more is we've talked a lot about things like K-shapes. We've talked a lot about the U.S. separating from the rest of the world. The longer this shock goes on, of course, it's going to change forecast numbers, but there's something a little more nefarious happening under the surface. We should be mindful of what that divergence underneath the forecast is going to do, both to households, but also to their sentiment shocks, how they vote. There are big implications to these shocks that are that create these divergences.
Francis, appreciate the update. Good to see you as always. Francis Donald there of RBC. From stag light to medium grade stagflation. Neither's good and one's worse, unfortunately. This is from Barclays. I think this is the boldest move I've possibly seen in the last 3 weeks in financial markets. Vinu Krishna raising the price target on the S&P 500 to 7650 from 7400 just yesterday.
Yeah, just again, and he's not completely alone. I think that JPMorgan also has a pretty high bogey when it comes to what they're expecting for the remainder of the year. To raise their forecast, he might be alone. I am curious how much people are seeing that earnings estimates are getting revised to the upside. You were talking about that at the beginning of the show, and I think it's a really important point. People look at that. AI dominance still very present, and saying you can still get all in. And frankly, the rest of the world's going to go all in as well.
We believe the US continues to offer stronger nominal growth than other major economies and a secular growth engine in technology that shows few signs of stopping. Raising the outlook over at Barclays. Venu Krishna, amazing. From New York City this morning, good morning to you all. The second hour of Bloomberg Surveillance up next.
We'll really start to see that energy price shock feeding through in the March data.
Central banks are going to be as hawkish as possible without hiking.
The Fed is going to have to become a lot more dovish in the medium term.
We think eventually that bond investors will kind of wake up and smell that disinflation coming.
What's really important is to take a step back, not get too worked up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and the price action looks like this. Equities higher by 0.8% on the S&P 500. On the Nasdaq, up 1%. In the bond market, yields down across the curve. 2s, 10s and 30s. 2s at 386. Only about 24 hours ago, 48 hours ago, we were talking about 4% on a 2-year yield following a very sloppy auction yesterday. More auctions to come later on this morning. We'll be looking ahead to a 5-year and 7-year auction over the next 24 hours. Setting the tone for this market, this move right here in crude. WTI and Brent lower by 6%. Brent crude at 98, WTI at 87. There is a lot of faith being put in the diplomatic process between the US and Iran, a process that Iran denies is even happening.
Yeah, as Bob Elliott of Unlimited Funds said on Twitter or X, whatever you want to call it, echoing what you said, the challenge right now is that there are two possible futures, escalation and de-escalation, with nearly opposite economic outcomes and asset returns. Question that I have, an increasing number of investors have, at what point do you reach diminishing upside just by virtue of how long this conflict goes on? And yes, you can get potential talks, as one side is saying, no talks, as the other side is saying. You can maybe get to a resolution. What does normal look like? And do we get the Strait of Hormuz operating in a way that actually does help facilitate the flow of a fifth of the world's oil and gas?
It depends how you look at it. There's a major difference between short-term transit risk, the Strait of Hormuz and reopening that and getting traffic moving again, and long-term production problems. This has already shifted towards long-term production problems, and we'll have to grapple with that for months. Even if this war is addressed, settled, peace comes tomorrow. Yeah. The problem now already is arriving in the data, stagflationary risk arriving in the PMIs, output down, prices up, and you're starting to hear more and more companies warn about what they believe is also a disconnect between the physical world that they experience and the paper markets we're talking about on a daily basis.
Yeah, you could put United Airlines right there in that, considering the fact that Scott Kirby is talking about $100 a barrel on average through the remainder of 2027, saying the prices are going to have to rise for airline tickets and that he expects demand to go down. How much are people thinking about that growth shock? That doesn't seem to be in the equation when people look at the response by central bankers, which is why they're starting to price in rate hikes. It is a very murky situation. The fact that you mentioned the 2-year yield, really interesting given the auction yesterday. Incredibly messy for a 2-year yield. Today we've got $70 billion of 5-year notes. Tomorrow, $44 billion of 7-year notes. How do people get any certainty around how to price the path of inflation and, frankly, term premium, given the backdrop that we're looking at right now?
Futures this morning, rosy, positive, up again on the S&P 500. Looking ahead to a few days of very important talks, potentially between the US and Iran. Coming up this hour, we'll catch up with David Lebovitz of JPMorgan Asset Management, with equities rising on de-escalation hopes. Galimberti of Rystad Energy on normalizing flows through the Strait of Hormuz, and Richard Clarida of PIMCO as central banks assess the Iran war shock. We begin this hour with stocks grinding higher as crude swings. David Lebovitz of JPMorgan Asset Management writing, we see more opportunity in US equities as the economy is more insulated from the energy shock than the rest of the world. David joins us now for more. David, good morning.
Good morning.
How are you characterizing this energy shock to clients at the moment?
So whenever there's a geopolitical event, we try to take a step back and think about what is the transmission mechanism by which this could impact the economy. There are usually two channels, one being fiscal spending, the other being commodity prices. And I think the point that you were just making about it's not only the level to which energy prices rise, but the duration at which they stay there that really causes a problem. Because, first it shows up at the pump, and that was evident on Sunday when we were coming back from the grocery store. Then it begins to show up in goods prices more broadly. Then it begins to show up in services prices. And I think that's really the concern right now. And that's what volatilities are telling you. If you look at the MOVE index, it still remains very elevated, reflecting that uncertainty around where prices are headed and what that inflation growth mix is going to look like going forward.
People are reflecting on a 2022 type shock all over again, and a shock to the market. And to be clear what we mean by that, stocks and bonds both struggle. Is it different in 2026?
So I think that there's a little bit of an offset, which does make it slightly different, which is we do have fiscal stimulus coming through this year. So there is a bit of an offset on the growth side that wasn't necessarily there back in 2022. But when I think about it from a portfolio perspective, we are looking at a world where stock bond correlations are flat to slightly positive. That means diversification isn't as easy to find as perhaps it is in a more normal negatively correlated environment. And that necessitates the use of things like real assets, not necessarily gold, but things like real estate and infrastructure as a way way of protecting yourself while we figure out exactly what the world's going to look like going forward.
Do you think that in some ways you could even upgrade your expectation for U.S. equities based on the growth and based on the fact that suddenly the rest of the world is seeing the U.S. as something of a haven again after rejecting it for a couple of months?
It's funny how perceptions can change very quickly, but I think you make a good point, which is, the U.S., we've seen energy intensity come down over time. We are a net exporter of energy at the end of the day. We are much more insulated from this shock than is the case for the rest of the world. You also think about the nature of our businesses, right? We tend to be very oriented towards capital light technology, communication services, so on and so forth. That's going to be the final frontier where I think you see these inflationary pressures show up. Where are they going to show up more quickly? Goods, staples, materials, and that's going to be punitive for some markets if it does result in demand destruction. And so we are viewing U.S. equities as a bit of a safe haven in this environment, despite coming into the year with more of a constructive view on opportunities outside.
What's fascinating is how much this year rhymes with last year. Everyone was talking about the broadening out at the beginning of 2025, how the broader economy would really experience a wave of growth. Then all of a sudden it was a Magnificent Seven again after Liberation Day. Are we going back to that kind of dynamic? Because the growth is going to come from price inelastic investments tied to technology, not necessarily the consumer feeling good about their situation.
So I do think that we are going back to a world where people view technology and growth stocks in the U.S. as a bit more defensive, but I do think that there's going to be more differentiation going forward. I'm not sure it's going to be this blind buy of the Magnificent Seven that we've seen over the past couple of years. The reason for that is that we have concerns in the credit market, and those concerns in the credit market are directly tied to software and technology. And so, I think people are going to put push their spectacles up their nose, if you will, when they're looking at these investments going forward. And it's not going to be about buying the beta. It's going to be about understanding as we go from adoption to implementation of a lot of these technologies where those alpha opportunities actually exist.
I find myself doing that all the time.
I know. I found myself doing that without even glasses.
Often when you're looking at the bond market.
Just, going like
and
this.
Overpriced equities. Inevitable when things get messy that people look for anchors and secular tailwinds. The question I have at the moment when it comes to tech and the secular tailwinds is just how cyclical the AI ecosystem might turn out to be in the next 12 months.
So I do think that you are going to see a period where volatility is challenged to decline, both on the rate side as well as on the equity side. I do think that there are some concerns around, can debt markets absorb the issuance that's coming from the hyperscalers? Do we have enough power to get these data centers, when they are up and running, to get them functioning? What does adoption actually look like? I mean, to me, this is kind of like the trillion-dollar question. If you look at the Business Trend and Outlook survey that the Census Bureau produces, you are seeing more and more businesses adopt AI in their day-to-day. But are we really seeing those productivity benefits? I think that saying that we're already seeing them, to my mind, is a bridge too far. And I think that's what investors are really looking for. They talk about the ROI on all of this. We're going to see it once it's there. Nobody's going to have an edge trying to forecast exactly where that shows up. The question is, are we seeing the productivity benefits?
Yeah.
Because to bring it back to the beginning, that's the cure for inflation, should it begin to become a problem.
When business is good and financial conditions are loose, it's easy to come out and say things like, the greatest risk right now is underinvesting and not overinvesting. And we've heard that from tech CEO after tech CEO. Let's go through the scenario. Let's say financial conditions tighten, and let's say business is not as good over the next 12 months. Who is upping their outlook for CapEx in the next 12 months? And how many companies are pressured by this market to do the opposite, to cut?
So I think more in the long term, and there's a very tight relationship between capital spending and profit growth. And so what we need to watch here, and earnings estimates have been incredibly resilient given everything that's been going on over the past couple of weeks. We need to watch what happens with profitability, because if the money continues to come through the door, even at a slower pace, I do think you'll continue to see investment by these large technology firms. But if you really begin to see profitability hit the skids and miss to the downside in a notable way, that's going to force their hand in the opposite direction. That's going to create questions among the investment community. Is the ROI actually there? Are they pulling back on their investment because they don't have the cash, or are they pulling back on their investment because they're seeing something else?
To build on what John is talking about, there already has been a slight tightening of financial conditions, but from pretty loose levels, and you still are seeing things getting done. If the Fed hikes rates, and there's right now a 1 in 5 chance of the Fed hiking rates, does that torpedo this cycle in a material way that is experienced in the equity market and beyond?
I'm not sure that it torpedoes the economic cycle, but I think it creates a significant challenge for the equity market. You know, coming into the year looking for 1 to 2 cuts, now we're talking about hikes. We're not just talking about hikes in the U.S., right? We're talking about hikes around the world. That creates a more challenging environment in a situation that you're already seeing that fragility begin to come through. Now, I think, again, the U.S. economy can take a few more punches than the rest of the world, given that fiscal support and given the health of the consumer, but obviously higher short-term rates, greater term risk premia, tighter financial conditions, that's tough if you're a risk-on investor.
David, it's good to see you. It always is. Thanks for dropping by. David Lebovitz there of JPMorgan Asset Management. I was just thinking about the Citrini research piece from a number of weeks ago, which of course no one talks about anymore because of this war, and the nightmare that they envisioned, which is ultimately that companies would substitute OPEX for CAPEX if the ROI was big enough, that you would see people cut their staffs to increase the CAPEX, to replace them with AI and agentic intelligence, and then the spiral, the deadly spiral begins in the year ahead, and we hope we go nowhere near that stuff.
But they're not alone. I mean, Anthropic, the Anthropic CEO has been banging the table saying the exact same thing, that a significant portion of white-collar jobs are going to go away, and you are seeing these job cuts being announced. You can argue why they're being announced at places like Block and whether it really is tied to AI. But yesterday, it just shows how we're not out of the woods when you have Amazon, AWS come out with new AI technology that torpedoes software stocks yet again and raises questions about the value there. So this isn't going away, and I think it's a really important question.
This is not going to win me any friends in that community. I really don't trust a lot of the stuff coming out of the leadership teams of the companies that are being run by these guys. I really don't trust some of the lines. I wonder what the motives are. I wonder what's behind it. Some of the lines coming out of these companies just feel so offside to reality. When you turn around and say you're going to lose 40% of the staff in any given occupation, you've got to wonder just what's behind that. Is it on the edge of arrogance? Is it well-informed? How is the government going to respond to that? How do you think the government's going to respond to that if you lost 40%, 50% of white-collar work in the next 18 months? How much tax do you think that company's going to face if that's going to be the case? All those things. It's getting increasingly concerning, these individuals that run these companies that could have all this power in years to come.
And part of this is a lobbying effort in Washington, D.C. to get ahead of some of those measures. They can get in on the ground regulating it now before they're regulated later in ways that maybe they don't really want.
Of course, the media that covers these stories, they want the access with the CEOs, right? So they entertain some of these ideas without pushing back aggressively.
I would argue you are getting market pushback, not so much with Anthropic, although on the margins, but with OpenAI. A number of people have actually canceled their deals with OpenAI and investments. There is more scrutiny, but not to the level that you're talking about.
Lost enough friends already. Equity futures positive by 0.9% on the S&P. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The U.S. drafting a 15-point plan to end the war in Iran. Sources telling us here at Bloomberg the plan was delivered to Iran via Pakistan. The details of the proposal are unclear, but President Donald Trump has said publicly any agreement would have to include a prohibition on Iran ever obtaining a nuclear weapon. We are seeing arms shares surging 12.5% in the pre-market following an announcement that the semiconductor designer will start selling its own chips for the first time. TSMC will produce the chips, and its first major customer for the product will be Meta, of course. The company expects the new business to generate about $15 billion annually within 5 years. And U.S. mortgage rates climbing for a third straight week. According to Mortgage Bankers Association data, home financing costs have risen to the highest level since October. The group's index of mortgage applications for home purchases fell 5.4% last week, the biggest drop since January. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. Up next on the program, President Trump's big triumph.
We've won this. This war has been won. The leaders are all gone. Nobody knows who to talk to. But we're actually talking to the right people, and they want to make a deal so badly.
We'll get into those talks in just a moment. Adam Hodge of Bully Pulpit International joins us next. Equity futures positive here by 0.9% on the S&P 500. A lift across the equity board on the Nasdaq, up by 1 percentage point. Bond yields lower across the curve. 2s out to 30s. 2-year this morning, 386. 10s at 431 later on this afternoon. Some issuance to look out for. 5-year notes today, 7-year notes tomorrow. Setting the tone for this market, this move right here. Brent and WTI lower on the diplomatic front. Things improving apparently. We're down by more than 6% on Brent to 97. WTI at 86.60. Under surveillance this morning, President Trump's big triumph.
We've won this. This war has been won. They have no Navy left. They have no Air Force left. They have no anti-aircraft equipment left. No radar left. No leaders left. The leaders are all gone. Nobody knows who to talk to. But we're actually talking to the right people, and they want to make a deal so badly.
So here's the latest this morning. The US sending a 15-point peace plan to Iran. Tehran signaling little willingness to compromise. Annmarie joins us now from Washington for more. Morning, Annmarie.
Good morning, Jonathan. Well, what we're seeing from the Iranians is a very much so, as you say, not there when it comes to compromise. Iran's armed forces had this to say: the level of your internal conflicts has reached the point where you are negotiating with yourselves. When it comes to this 15-point peace plan, according to Pakistani officials speaking to the Associated Press, the Iranians have been delivered it. And a lot of on the table is things that we've been talking about, and this administration was already talking to the Iranians about before the conflict began. And I want to talk about how the United States is conducting this conflict. We're joined by our colleague right now, Katrina Manson. She just wrote this entire book about Project Maven, which is being used right now from the DOD to deploy this war in Iran. And yesterday, the Palantir CTO, Katrina, told our colleagues Ed Lolo and Caroline Hyde that when you look back, this will be the first big conflict where AI is part of it. What are you seeing?
Yes, he said that this conflict is, we'll look back and see that it was driven, enhanced, and made substantially more productive by the help of AI. It's an interesting turn of phrase. I think it points to the number of targets the US has been hitting. 9,000, more than 9,000 so far, more than 1,000 in the first 24 hours of the operations. And that comes down to Maven Smart System, a product that Palantir makes that can rapidly identify targets and pair them with weapons. Now, that's not to say that hitting targets alone is the answer, but speeding those processes has perhaps buoyed US confidence that they could deliver a result.
And it maybe accelerated some of their targets in terms of strategic targets for trying to win this conflict. We also heard, though, from the president's former defense official yesterday, Jim Mattis, who was saying that hitting targets is not enough.
Yes, he really focused on this word targetry, to say targetry is no substitute for strategy. And the whole point of AI, bringing that breadth of data into the battlefield, has always been claimed to be about bringing greater intelligence for decision-making. So if it has enabled hitting a lot of military targets without understanding the impact that taking those targets out might have, there's really a disconnect. And I think the US military operators will have to focus on what it is that actually starts and ends a war. And perhaps Trump will be asking chatbots, how do I open the Strait of Hormuz?
Wow. Potentially that's going on right now at the DOD. Katrina Manson, thank you so much for your time. And I've started her book. Absolutely incredible to understand how AI has been working through the Department of Defense and how it's being used right now on the ground. But Jonathan, to back that up, we also need to bring up to the point 2 Marine expeditionary units are on their way to the Middle East, as well as being deployed, 2,000 soldiers from the 82nd Airborne.
Annmarie, appreciate the update down in Washington, D.C. The prospect of facing down substantial two-way risk heading into the weekend. Let's talk about the diplomatic effort. Adam Hodge of Pulpit International is saying the White House doesn't have the structure or people in place to find a durable solution to the war they started. Adam joins us now for more. Adam, good morning.
Good to be here.
Good to see you in person. So let's get to a question we've asked many times in the past 3 weeks. When we say Iran, who are we talking about? When the US says we're talking to Iran, who are they talking about?
It's really unclear. I mean, what you've heard from the president in the comments he made yesterday, that we've killed most of the people that we were then talking to. Even at the start of the war, he said there's all these people that we're going to talk to, but now most of them are dead. It's hard to negotiate and have find a real deal if you've killed the people that you could be offering the deal with. And I think the key question that I have going forward is, how do they actually resolve this war in a way that is durable, that is sustainable? And I keep coming back to the fact that you need people in place who understand the country, who understand the ins and outs of the market in the region to really reach a lasting deal. And you get a lot of mixed signals over the last couple of days.
It's one thing to have some sort of cohesive crew in the United States. It's another thing to understand who we is when this is a multifaceted war being fought by Israel with increasing participation, or at least buy-in, say-in from Saudi Arabia and UAE and other regional countries. How closely do you think that all of these different nations are aligned right now with signals coming out of the White House?
I've been a little bit concerned with it seems to be somewhat of a rift or a gap between the U.S. and Israel and some of the strategic priorities. And I think that is a question like, how do they continue to coordinate? Do they continue to attack the right targets? Does that coordination continue? That, I think, going forward is a question. I think you've seen reports, Mohammed bin Salman in Saudi Arabia, openly pushing the White House and the president to go deeper into Iran. You've got 5,000, 50,000 troops already in the region. The Marine Expeditionary Unit on its way. They're not going there to get a suntan, right? They're there to do lethal work. The 82nd Airborne, also very lethal. And so I think that is a sign to Iran that this is a good chance that this conflict does continue. And they just have to look back to what happened at the start of this conflict. They were negotiating a deal. They were willing to give up their enrichment. And we then bomb them. So I don't think that if you get a 15-point plan, they're going to be all that quick to try to resolve this conflict if they are watching the same vessels and the same troops moving to the region.
At the same time, the Democrats have come out and tried to pass legislation putting a stop to some of the incursion by the U.S. in the region. Do you think that that is a viable solution, given the fact that essentially that would give Iran control over this crucial waterway should the U.S. walk away now?
I mean, I think what Democrats say is like, we should never have gotten into this conflict in the first place, right? And so the quickest way to get is to find a negotiated solution to the war. Now, we're in this box. We're in this Pandora's box that the president got us in. And so it is ultimately the president's responsibility to get us out of it. I think the key is if you do hold back some of the funding for the war, it puts the pressure on the president to do that. And now I think that is without boots on the ground right now. The Defense Department has all the money that they need to wage this war. I think the more you start putting, if American boots go on the ground, which the president said was a red line from the beginning of his administration, then it becomes a harder political issue for the Democrats to hold on to. But for right now, I think they're on pretty firm footing.
Adam, it's good to see you. Thanks for being here. Yeah. Thanks for breaking it down. Adam Hodge there of Bully Pulpit International on the very complicated, and I think we should stress that, very complicated diplomatic effort heading into the weekend.
It is incredibly complicated because we don't know who's negotiating with who. We don't have a sense of how concrete any deal could possibly be. We don't understand exactly what kind of consensus there is among people who are ostensibly fighting in tandem. And it's unclear how dependable any kind of truce could be, given the fact that Iran is waging an existential battle and is now claiming this power in a way that it knows it can use as a cudgel. It is talking about how oil prices need to go higher to exert that influence and that pain on the global economy to show their clout. So this is an incredibly difficult situation on every single front.
We keep framing the calendar. We should keep going back to the calendar. Adam talked about it. By the weekend, you've got a new deadline, a self-imposed deadline by the president. Let's talk about the original deadline. It was to really escalate things and go after Iranian power plants. That's been pushed back. We avoided the escalation, but it's been pushed back, delayed potentially. You face substantial two-way risk into the weekend. Either you get the ceasefire, a diplomatic resolution of some kind, I've got no idea how durable that would be, or you end up in a situation where you have an increased military presence in the region by the time you get to the weekend and a totally different option about how to progress and move forward.
This is a reason why a lot of people feel pretty paralyzed, and that's why it's pretty shocking that Vina Krishna actually increased his target for the S&P 500.
That's a trade for the brave. I respect that.
I respect that too.
Make a call.
Go
He's
for
making
it.
a bold call. We'll catch up with Venu in the next week or so. Up next on the programme, Claudio Galimberti of Rystad Energy on stabilising flows through the Strait of Hormuz. It is the first thing we look at every single morning. It looks like this morning. I'm sure you're intrigued if you're just waking up. It's lower, by the way. Crude down by 6%. Brent back to 98. WTI down by 6%. Also 86.84. Setting the tone for this in the equity market. Equity futures higher across the board, up by 0.9% on the S&P. On the Nasdaq, up by 1 full percentage point. In the bond market, actually quite a volatile couple of days in fixed income. And you don't usually see that volatility at the front end of the curve. The 2-year, usually very sensitive to what the Fed rate path might be. 386.27, yields down by 3 basis points. And usually when you get a back up in yields, say 4% on 2s, which by the way is above Fed funds right now, you get a decent set of demand coming into the market as well. You did not see that yesterday at that auction.
Yet not only did you have dealers take down the greatest amount going back to 2022 of this 2-year yield auction, but you saw yields go up, actually sold at a higher level, priced lower at the actual auction. That's where they traded immediately after the sale, highlighting that people didn't feel like they were being sufficiently compensated. How do you make any trade in this market, given the fact that you could be whipsawed by a headline, given the fact that you don't know who you're playing against, and given the fact that the backdrop is just so uncertain?
I'm pleased you went there. Let's go there.
Okay.
If you're in the market right now and you've witnessed the past few days, particularly what happened on Monday morning, is that going to lead you to reduce how much money you put at play in this market right now? Does that lead to a reduction in liquidity? That's what I'm trying to figure out in the next few weeks. If this carries on, if you keep believing the perception that someone has a line, some information that you don't have, and that you're vulnerable to a headline or a social media post in the next several minutes, do you want to take risk in that kind of market? Because the kind of market that gets fantastic liquidity is the kind of market that has fantastic transparency. And if you start to question the lack of transparency, I just wonder what happens ultimately to liquidity.
So anecdotally, I've been speaking to a number of investors over the past week, and they all say, I can't trade this. This is completely untradeable. This is a market that does not feel like it is rational or something that I could have an edge in. They are pulling back. You see that on the margins with cash balances going up. Whether this leads to a full pullback in liquidity, I think is a fair question. Inconclusive at this point. It feels like a casino where you thought you were playing at the poker table, and now you're playing at the slot machine, and the house has rigged it every single time. And it is not a fun place to be.
Coin flipping at the moment. Really does feel that way. $1 trillion coin flips at the moment. Equity futures still positive by about 1% on the S&P 500, 2 hours away from the opening bell. Let's get you some morning movers. Yahara has more for you. Hey, Yahara.
Hi, John. Airline stocks have felt the brunt of this conflict, but today they are all higher as investors lean into signs that the situation with Iran may not be getting worse, at least for now. But the backdrop for the airlines remains strained. We still have an ongoing partial government shutdown, so lines out the door at airports still. United CEO telling Lisa yesterday that demand remains strong despite all the issues going on in that sector. Meanwhile, moving on to KB Homes, those shares are down 4.25% after the builder issued a weaker than expected forecast for deliveries. The company pointing to a more cautious consumer, still concerned about affordability, and adding to that, KB Homes saying that concerns around the Middle East conflict are creating another level of uncertainty for buyers. Add to that still elevated yields, and it's a tough time to buy a home. And we end on ARM shares on a good note. Those shares rising nearly 13% in the pre-market as the company moves to start selling its own chips for the first time, moving beyond its traditional licensing model. It's a big pivot as it takes aim at the growing data center market tied to AI. And the company expects this business to generate about $15 billion annually within 5 years. John.
Yahara, thank you. Appreciate it. More from Yahara a little bit later. On our radar this morning, the United States proposing a 15-point peace plan to end the war in Iran. The plan reportedly requiring Tehran to dismantle all of its nuclear capabilities and fully reopen the Strait of Hormuz. Elsewhere, Iran allowing some foreign vessels to pass through that strait. Officials saying ships can cross as long as they are not supporting acts of aggression against the country. And finally, elsewhere, the DOJ admitting it found no evidence of a crime in its investigation into the Federal Reserve renovation project. The revelation reportedly coming during a closed-door hearing earlier this month. The judge calling the probe an illegal attempt to pressure Fed Chair Jay Powell.
First of all, can I just say, remember, and I'm reminiscing fondly, remember when we were thinking that this was such a big story? This was the biggest story of the day, sort of a question about the fate of the Fed chair and just this shenanigan with respect to what the Justice Department would do. Look, This goes back to the point that you and Annmarie have been making a lot, which is why didn't the Trump administration, why didn't the U.S. attorney take the win and just simply say, OK, Supreme Court, or OK, court system, we'll just simply drop this case, allow the nomination process of Kevin Warsh to go through and be done with this? Why dig your heels in? And this just adds to questions around that.
I don't know. Here is what I do know. As things stand, things could get very, very messy this summer, based on the three-point plan that came from Chairman Powell in the news conference last week, which is, I'm going to stay if no one's confirmed. I'm going to stay if the DOJ investigation hasn't wrapped up. And I'm not committing to leaving. Even if those other two things happen, I might stay on the board of governors for the time being until that term expires. Stay tuned. Think about what that might look like later this summer.
I think the administration is already thinking about it, and they've signaled that they will probably contest it legally and that they don't think that there is necessarily the pro tempora precedent to have him stay on as Fed chair. That in the past, when someone has stayed on as Fed chair, they were going to be already the next Fed chair. They just hadn't yet been confirmed. It wasn't necessarily waiting for the confirmation of another figure. It may get messy, whether it affects the path of an already highly volatile Fed funds rate.
Yep.
Just gives you a sense of how much is at stake.
It's not going to help, that's for sure. We'll catch up with the former Fed Vice Chair, Richard Clarida, a little bit later this hour. We'll get his thoughts on the politics and on the policy. Let's talk about crude. Prices falling this morning as President Trump signals a possible off-ramp for the war with Iran. Claudio Galimberti of Rystad Energy writing, even if a ceasefire were to be agreed today, it will still take at least a couple of months to normalise the flows through the Strait of Hormuz. Claudio joins us now for more. Claudio, welcome to the programme. We've seen headlines coming out of Asia about rationing. We've seen those building over the past few weeks. How long before we start seeing similar things in places like Europe and maybe even places like California?
Thank you for inviting me, John and Lisa. I think we are only weeks away from a situation of rationing if the Strait of Hormuz remains virtually closed. Now, there are some good news, of course, coming today from the White House, potentially from Tehran. We should welcome those. But let's not forget that as of today, 10 million barrels a day of production in the Middle East are shut in. And this is an unprecedented situation. And the benchmarks for Asia, for crude in Asia, are still well above $120, $130 per barrel. And these, I think, are more representative of the situation on the ground. So the rationing that we begin to see right now in Asia was well forecasted, and before long, if the Strait of Hormuz is not reopened, we'll see it in Europe. As far as the United States is concerned, the situation is less of a problem because the United States, let's not forget, it is a net oil exporter. But even in the United States, in some parts, we'll begin to see some problem at some point.
Claudia, let's draw a distinction between short-term transit risk, which is the Strait of Hormuz, anything can happen there at any moment, and long-term production problems. We've seen damage to production facilities already. That's going to take time to repair physically. What I think is less understood by people outside of your world are the wells themselves. We often talk about them as if they're taps. You can turn them off, turn them back on again. When you shut in production, how difficult is it to restart? How long can it take?
The rule of thumb says that the longer they stay shut, the longer it's going to take to bring them back to the previous level, and you might not get there. So let's suppose that right now we are in the fourth week of the war. Rule of thumb is going to take, if the war ends today, it's going to take 4 weeks to bring them back on average. Of course, some it's going to take a short amount of time, some it's going to take much longer, but on average, that is the rule of thumb. And it's not a given that it's going to cost a lot, by the way, to bring them back. And it's not a given that you get to the same level. So it's always a complicated thing. And that's why all the producers are very, they don't want to do it. They don't want to shut in. They exhaust all the alternative. And eventually, in this case, there was no alternative. Because we were reaching containment in the tanks. Started in Iraq, Kuwait, and then pretty much right now it's all around the Middle Eastern producer west of Suez. So that's unfortunate situation, and that's the reason why we need to be careful at assuming that once the war is over, then the situation normalizes. It's going to take logistically and from the production perspective months to go back to normal. And as you correctly pointed out, Jonathan, for those facilities that have been damaged by the bombing and by the missile, that can take years, right? So we know Ras Laffan in Qatar, which is the LNG facility, that may take 3 years to, according to the Qatari. And we don't know how many facilities have been, there are some rumors that there are more facilities being damaged across the Middle East than we actually know. So
Claudia,
we need to be aware of that.
There are two conclusions that you could draw from this. One would be because there could be destruction to the actual production facilities that takes a longer time to bring back on, that prices will be higher. On the flip side, you could say demand destruction is going to really start to kick in, especially because it's actual physical shortages in certain places, particularly in Asia, and that could potentially cap how high prices could go. At what point has that dynamic started to play into the equation?
Excellent point, Lisa. I think that we need to be careful at assuming that demand will be a shock absorber, because we're talking about 10 million barrels a day of shock on the supply side. To assume 10 million barrels a day of shock on the demand, it's basically we need to go back to COVID, right? So remember when we were all shutting down and being inside the house, and that's not going to happen. So there's going to be some rationing, and probably starting with petrochemical, because that is a very long supply chain, and therefore it can absorb basically the rationing much better. Then it's going to be jet, and then it's eventually going to hit all the transportation fuel, main transportation fuel, diesel and gasoline, if it continues. But let's not forget that we still have a lot of inventories around the world. So things can we're not necessarily in a nightmare scenario. But at some point, the oil demand will start to be curtailed. And but assuming that all the supply is going to be matched, the supply shock is going to be matched by demand, that's really a very, very dark scenario. I don't think that that's going to happen. So what I think is going to happen first is that if this is not resolved, prices are going to scale up at a very high level. At that point, you're going to have some discretionary travel is going to be trimmed. We're probably going to have some impact on the economy at some point through inflation, through higher interest rates, and then demand will start to fall. But it's going to take some time even for the demand to actually readjust. So it's a long process. We are still in the middle of that, I'm afraid.
Hey, Claudia, it's good to see you. Thanks for the update. Let's do it again soon. Claudia Galimberti there of Rystad Energy. I'm not enjoying the phrase demand destruction at the moment. I understand where it comes from, but it almost implies that prices get so high that people just aren't willing to pay them. When actually what it means right now in places like Asia is just pure shortages. Demand is being destroyed because people can't access the thing they need. It's a shortage problem in so many of these places, and the price is a reflection of that shortage.
Wasn't it Jeff Curry who came out and said that we will experience what happens with respect to people understanding the scope of this energy situation when there are lines? Yep. At the pump. And that, I think, really goes to what you're saying. It's not that people don't want to pay. It's when people won't be able to access the gasoline to power their vehicles and have to go from gas station to gas station. And that, I think, is what a lot of people are worried about.
Different way of framing things. Of course, you'll see both to a certain extent, but it's the shortages that I think is just front and centre right now. And the Shell CEO basically saying that what you're seeing in Asia, you'll see in Europe next. That's when people might start to wake up big time to this cascading through the global economy and not just being a problem for Asian importers.
And there is a demand destruction aspect to it that actually is people choosing not to pay. And that is when the prices are passed through different goods and services, and suddenly people start to ration how much they go out, ration how much they travel. And that is the hit that people are very concerned about right now, how that plays through in a stagflationary type of feel in the market.
The story better in energy this morning. We're down by 5 to 6%. Brent at about 98.56. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
On that note, John, Chevron is warning that California is heading toward an energy crisis because of the war in Iran. California is highly exposed to the disruption because it imports about 20% of its refined fuels from Asia, which is struggling, as you said, to meet its own demand. Chevron says it may quit refining oil in California within a decade unless officials cut taxes and regulations. OpenAI plans to discontinue its Sora AI video generator and wind down its partnership with Disney. The move coincides with the ChatGPT maker's push to streamline its product lineup. In the staff memo, CEO Sam Altman saying it plans to reorganize to raise capital and focus on infrastructure projects. And JPMorgan Chairman and CEO Jamie Dimon says China is beating the U.S. in specific strategic areas and needs to acknowledge Beijing's advancements.
Our GDP per person is $85,000. Theirs is $15,000. We should acknowledge they've done some things magnificently well. We should look at our own shortcomings and then be prepared if they ever become an adversary to face off against.
Dimon also warning that AI could cost the U.S. jobs and suggested the government could create an incentive system for businesses to help soften the blow. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. Up next on the programme, committing to anchoring inflation.
We will not be paralyzed by hesitation because our commitment to delivering 2% inflation over the medium term is unconditional.
Up next, we'll catch up with Richard Clarida of PIMCO, the former Fed Vice Chair, right here in the studio. Just off session highs, stocks are still positive by 0.8% on the S&P. On the Nasdaq, higher by 1 percentage point. Setting the tone for this is what's happening in the energy market. Crude lower on Brent and WTI, down by some 5%. Brent around 99, WTI around 87. Some confidence, apparently, in the diplomatic push from the U.S. side heading into this weekend.
Well, the signal is actually important, which is, at least rhetorically, the U.S. is de-escalating and pushed back the accusations about what would happen should there not be some sort of agreement. This alone was enough to get people somewhat excited.
Signal's important, substance is too, and at the moment Iran says there is no diplomatic effort to engage in.
Well, yeah, Pakistan's maybe doing this, right? And let's just take it as bullish.
We often ask all the time, who is Iran? Who is talking to who? And when Iran denies it, who is Iran and who is saying that? And it's very complicated right now. Imagine being a central banker trying to set policy. Under surveillance this morning, committing to anchoring inflation.
And we will not act before we have sufficient information on the size and persistence of the shock and its propagation. But we will not be paralyzed by hesitation because our commitment to delivering 2% inflation over the medium term is unconditional.
So here's the latest this morning. The ECB among central banks assessing its next moves as the extent of the Iran war energy shock remains unknown. Joining us now to discuss is the former Fed Vice Chair and Global Economic Advisor at PIMCO, an old friend of this programme, Richard Clarida. Rich, good to see you, sir.
Thanks for having me.
Thank you for being here. This feels different for the ECB versus the Fed. Is that fair?
I think it's fair. I think, obviously, the shock is probably going to be larger for them, given their imports of oil and natural gas. Also, remember, the ECB has a single mandate. Their job is price stability. The Fed has a dual mandate. And so I think they are data dependent. I take them at their word. I don't think a hike is a slam dunk, but it's an option.
Is this a shock you should look through as a central banker?
My inclination would be to look through it initially, although the caveat, of course, is the last 5 years, inflation's been too damn high and above target. So I think that's a case to maybe think a little bit harder about it. But my inclination would be to look through, especially given, I think most economies, including the U.S., are at a point where if we do get a stagflationary shock, there will be a contraction in growth and higher unemployment, and central banks are going to have to factor that in as well.
Well, with the ECB right now, markets are pricing in a number of rate hikes for the remainder of this year. And in the past, there has been a history for the ECB of hiking in the face of an oil price shock. Do you think that would be a policy error that would send the region into recession?
I think it's a possible policy error. You know, you don't have a crystal ball, at least as a central banker, so you make those judgment calls. But you are correct. Both in 2008 and 2011, as I recall, the ECB was hiking when headline inflation went up for an oil shock, and both of those moves, in retrospect, did not pan out too well. So I think that could be on their mind.
PIMCO recently put out a paper pushing back against some of the rate hike expectations in the United States, saying it's a little bit overdone given what the rhetoric has been and the dual mandate that we're facing. Do you think that a rate hike, that the bar is just so high that it really wouldn't happen, especially under Kevin Walsh whenever he gets in?
Well, Jay Powell was asked that question at the press conference, and I think he said again, as he did in January, that the committee's not really considering a rate hike now, and it's really not something that They anticipate. You do have some members of the committee, I think some of the presidents, who would like the statement at least to acknowledge there could be a rate hike. I do think the bar is high for a couple of reasons. The Fed is a dual mandate central bank. The unemployment rate is low, but let's face it, job creation's been virtually zero for the last year or so, especially in the private sector. And I don't think it would take much to push the unemployment rate up, and I think that'll also be a factor for them. So I think the most likely path is the uncertainty in the Middle East may put them on hold for a while, but I think eventually this will be resolved. It'll be in the rearview mirror, and I think at that point, Kevin Warsh, when he does arrive, will be inclined to lower rates at least down to the neutral level of around 3%.
Can I talk about football, but the international kind?
Okay.
Okay, right.
Have you ever asked for permission to talk about football?
When you are defending a corner, the rules of the games are, ultimately, the unwritten rule of the game. As a manager, you shouldn't make a substitution in that moment. You shouldn't change things up. Things can get complicated. It feels like we're doing more than just defending a corner later on this summer, and you've got the captain refusing to come off potentially, and another guy that wants to come on. And this can get really, really messy. Is this working? I hope it's working.
I think it's great.
It's working. I'm with you, John.
Can you explain to me what this is going to look like later this summer?
Well, there's the very real prospect that at least for a meeting or two, or perhaps more, that you'll have a Fed chair, Warsh, and you'll have a Governor Powell who remains on the committee. The last time that happened was in the 1940s, when a Fed chair named Mariner Eccles stayed on as a governor for 4 years when Truman selected another chairman. And so I think it could complicate things for Kevin Warsh. Kevin Warsh knows the Fed. He was a governor. Kevin Warsh understands that to raise or lower rates or to buy or sell treasuries, you need to get a committee vote. And so he only has one vote. And I think, obviously, Powell, if he stays on, will be a very persuasive voice on the committee, even as a governor, Powell.
Do you think the chairman is right to worry so much about central bank independence that it requires him to stay beyond his term as chair?
I think we're at a juncture where it's important for the Fed as an institution to demonstrate that it will make decisions based upon its mandate. I think Warsh is a good choice to bring that about. I expect he will get confirmed and will go in, I think, with that support and expectation. I would not expect Jay Powell to stay on the Fed until the remainder of his term, which is January of 2028. But I think given the circumstances that we're in, and in particular the ongoing issues the Fed is navigating, he may well stay on, I think, for some time.
Rich, you're a gent. Thanks for entertaining me.
Thanks for
Appreciate it.
me.
Thank you, sir. The former Fed Vice Chair, Richard Clarida, now with PIMCO on the future of this Federal Reserve.
Yeah, and how things might get messy, but they will shake out, given the fact that, frankly, Kevin Warsh has been represented and respected by a lot of people who really fit within the establishment of the economics profession. So it's not as though it is a rogue character coming in, which raises a question how much he can really cut rates, although Rich did say it's neutral or below.
If this war continues, this is going to be a really difficult moment to communicate policy. And I don't think you want confusion about leadership at that moment. And that's where we might be in a few months' time.
I'm just watching the MOVE index.
Right.
I mean, that's essentially giving you a sense of just how much concern there is and lack of clarity.
No more football in the next hour, don't worry. Coming up, Stuart Kaiser of Citi, Crispin Love of Piper Sandler, the Republican Senator Dave McCormick, and Matt Zizok of Merrill and Bank of America Private Bank.
It's just so difficult to determine what's going to happen next in this market.
If we continue to see this volatility, there likely will be long-term buying opportunities.
There is a big disconnect between the physical and the financial markets.
The risk aversion has been increasing dramatically.
At the end of the day, we have to ask ourselves the questions whether or not these positive trends can continue after the war.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. The price action, your scores look like this. Net session highs at 1% on the S&P 500. Similar move elsewhere, and the Nasdaq up by 1.2. The Russell up by 1.4. In the bond market, yields declining across the curve. 2s, 10s, 30s, 2s down 3, 10s down 5, 431 on a 10-year maturity. And setting the tone for markets worldwide, this board right here. WTI and Brent. Brent crude down by close to 6%. Likewise on WTI crude. A lot of faith, a lot of hope in the diplomatic effort and the push coming from the US side heading into the weekend.
Yeah, and it's not just in the actual futures, but when you take a look at the 6-month and 12-month curve, you're also seeing levels come in. There seems to be more of a sense that the signal is more important than the noise when it comes to, the signal is more important than the substance when it comes to President Trump. The fact that there was a ratcheting down in the pace of rhetoric and just how heated things were, that there wasn't some sort of attack on oil futures in Iran, seemed to be rejoiced upon by markets that have been absolutely beset by a slew of headlines.
I've never liked the taco phrase, and we can get into that another time. It takes two to taco is a phrase I've heard a million times over the past 3 weeks or so. This is not just in the president's hands. Is Iran on board with this? They came out in the last few weeks and said, we want to make sure that this never happens again. Establish a long-term, durable deterrence. Now, they're going to have a lack of trust when they come into these talks. The US will have a lack of trust coming into these talks as well. Justifiably so, given how Iran's behaved over the last few decades. That makes it very difficult to get this peace plan agreed to in just several days' time.
That's the reason why I don't totally understand why this is a tradable market. And I'm sure our next guest will explain why this is a tradable market in any kind of way. How do you get any edge? How do you get any conviction? How do you get a sense of whether people are overly bearish when you don't know how long this is going to last? You don't know whether this is a delay just to get troops in position to potentially take this a step further, which is a speculation among some, including Iran. I mean, there's so many questions here that are so out of everybody's hands and sight that I just wonder how you get signal from this and say, I want to play in that.
The fear of missing out seems to be greater than the fear of losses right now, even though we're confronting substantial two-way risk in a few days' time.
And part of the reason why is because people say, look past the noise, if you can call this noise. And typically geopolitics does not have a lasting effect in equity markets. And U.S. equities still look good. Profits are still increasing. You are seeing companies, particularly tech companies, investing heavily in their infrastructure, and they want to go back to that and say, look, it can be a viable dip. Whether that's the case remains to be seen.
So buy stocks. Vinu Krishna over at Barclays just sent me a message moments ago as we've been talking about this call, raising your outlook on the S&P 500 in a moment like this one. Quality move. I think that's bold. I respect it, whether it's right or wrong. 76.50 is the price target now over at Barclays. They've raised the outlook for earnings as well. They acknowledge that the scenario analysis skews left, so more bear downside than bull upside. But ultimately, the earnings outlook for them is solid enough, the tech story is strong enough that they've still got this commitment, this faith, optimism, if you will, in the US stock market story.
Look, a lot of the big tech names are still investing heavily and are price inelastic because it is an expectation of efficiency gains and revolution in the eyes of many that is worth the investment. And for that reason alone, not only do some people see their prices and their valuations going up, but they're increasingly a haven for the rest of the world that now are wondering, okay, what about gold? Nah. What about Europe? Nah. What about Asia? And so suddenly the U.S. seems to be a better trade again.
Asia, I apologise. That's not directed at anyone in particular. Okay. Anyway, I'm just making sure we clear that up, just in case someone's awake and they're watching.
Oh yeah, look, no, I'm just saying, okay, in terms of markets, whether it's the haven. I'm talking
important
markets.
To clarify. People are easily offended these days. All right, it's important to address those
Thank
issues.
you. Thanks for trying to save me. I appreciate that.
Equities on the S&P up by 1%. Coming up this hour, Stuart Kaiser of Citi. The stocks whipsawed by diplomatic efforts. Crispin Love of Piper Sandler. Stress continues building in the private credit markets. And Senator Dave McCormick breaking down President Trump's 15-point plan to end the war. We begin this hour with stocks rebounding on hopes a ceasefire might be on the horizon. Stuart Kaiser of Citi writing, we're still not buyers of the proverbial dip. The tail risks from this event are time-dependent. The longer it lasts, the worse they get. Stuart joins us now for more. Stuart, good morning.
Good morning.
How long are the tails from this one already?
I think they're getting pretty long, and I think it actually takes three to taco in this case. And I would add in the Gulf countries here that they need to be accepting of whatever this resolution is, because essentially their economies are being held hostage by the Strait of Hormuz. So I think it's a very complicated thing. I think you're maybe playing for 3 to 5% to the upside, and your downside tail risk could be 10% plus. So we just don't like the risk reward here. I would say if you want to be positive, you have had a lot of de-risking. The bar for bad news is obviously exceptionally high here. And people remember what happened last spring, which was when Trump started to soften his rhetoric. You wanted to add risk. So I think you have this tactical, trade going on. But again, the medium-term risks are extremely large here, and we're being very careful about it at this point.
Should we get to the Bramo question? Let's just hit it head on. How tradable is this market?
Not very tradable. I mean, it's been a very, very difficult kind of intraday, trading environment. A lot of headlines are happening in the overnights. You're getting large moves that you couldn't even hedge or risk manage to begin with. So extremely difficult. I think you also have, you mentioned AI. You've had this environment, too, where you trade Iran risk for 2 days, but then you'll trade private credit risk for 3 or 4 hours, and then you'll trade AI risk for 6 or 7 hours. So, like, hedge funds in particular who are thematically invested are getting kind of yanked in 3 or 4 directions. So extremely, extremely untradeable market, I would say.
Well, if John's going to ask my question, I'll ask his question, which is, at what point do people withdraw liquidity then from the market? Because how do you get an edge, given the fact that you don't know who has more information than you are? You don't know who's putting on a big trade when it comes to oil or when it comes to a certain sleeve of equity holdings?
Yeah, and look, I think it is time in the end. I mean, I think the negative, in that context is that longer dated oil has started to move. And the question, I think, on all of this is, do we just get the front down, or does that 2-year oil, which went from 60 to 70, start to come in a little bit? I'd say the one positive is that long-only investors have generally not participated in the selling over the last couple of weeks, which is positive, because long-only sells when retail pulls out, and long-only sells when they get extremely, worried about, I think, the macro conditions. So that would be the big risk, I think, is if this lasts long enough that it becomes a recessionary risk, do you start then to get long-only money kind of pulling out of the market? And I think that would be, to your point, liquidity sort of coming out of the system.
Has the deck already been restacked, not only with respect to oil prices, but also the reaction function from central banks? The idea that we're pricing out rate cuts, you can argue all you want about whether rate hikes are truly on the table in the United States. It is a very different backdrop. Does that automatically mean that risk assets just cannot do as well, given that constraint added to the potential concerns in private credit?
Yeah, look, the central banks are in a tough spot, I think, particularly in Europe, where you're kind of inflation targeted and you might be tightening into a very large demand shock, from higher oil prices. So it's an issue, and it does create, I think, negative risk reward in a lot of markets. I think Europe in particular is a part of the market that we're not looking to dip by, especially, if we were going to put some risk on. You could talk yourself into Japan or Korea, which have sold off a lot, have a lot of oil exposure, but also have positive AI trends, positive memory trends. The U.S., the same. You have a Fed that's dual mandated, that has a generally strong economy already, and that also has kind of the AI impulse. If you have higher energy prices, structurally, that is a massive impact on Europe, and you don't have the good news on the AI side as well. So I think Europe is the area that we're most concerned about from a risk-reward perspective. But to your point, I mean, it's tough. I mean, there's not a whole lot of good news out there right now.
And the argument as to why they won't hike rates is hardly encouraging either. If you're turning around and saying the likelihood of second-order effects are low because the economy is not as great as it once was, that's not a great argument to buy risk either.
Either way, you start to wonder at what point does that affect the broader market trade, and it includes even AI. And you talked about this, John, but the idea of how much money some of these companies are raising. Can they raise that much money if private credit funds aren't raising money right now? And frankly, if they're facing redemptions, and if you see banks tightening up their standards, it creates a higher bar. At what point does that bleed into some of the investments?
April 24, I think it's Alphabet. The week after, you're going to hear from Microsoft. CapEx budget's in focus for me. If the economy's not doing as well, if financial conditions are tight, what's the outlook for CapEx from those big players?
Well, I mean, honestly, the economy is CapEx, right? I mean, most of the GDP growth came from CapEx last year. To Lisa's point, I do think they are relatively price independent here. I mean, they view this as existential. They need to do their spending. But the CapEx impulse into U.S. economic growth was massive. So even if that just starts to flatten out at a very high level, that means your growth rates are slowing, right? And that is kind of a risk going forward. And look, we've seen, Blue Owl tried to raise money for that data center for CoreWeave. It was only $4 billion, which actually isn't that big a number in the context of data centers, and didn't get that done. So, yeah, there's a lot of kind of, wobbly pieces out there right now. But, we are still an economy with relatively low rates and an unemployment rate of 4.4% and a massive CapEx, kind of spending tailwind. And tax refunds are coming in, not great, but pretty strong as well. So there are some positives. It's easy to kind of focus on all the negatives.
Well, now being spent on energy bills, and that's probably the problem too. On credit, on private credit, we'll have this conversation in a bit more depth in just a moment. If redemptions are up, is it fair to say that loans being underwritten are down? Isn't that fair to say if you're seeing one, you're going to see the other? And the read-through to the broader economy, powered by private markets in a much greater way over the last several years, it's not great, is it?
I think the debate there with private credit is this something that looks like 2007 and 2008, or is this something that looks like a couple years ago with commercial real estate, where everybody was very worried about commercial real estate values collapsing, the impact on banks. You had a big ETF that everybody wanted to be short. You had alternative asset managers that must be exposed to this. And it ended up being a much smaller problem than we imagined. So I think for private credit, that's a little bit of the debate right now. Is this a sort of problem that we can size and compartmentalize, and it's not big enough to be a global financial crisis? Or is it something where there's a lot of leverage in the system and it becomes kind of a cascade effect?
It depends how you come at it. I'm not looking at it from a systemic risk perspective. We can do that. I can entertain that conversation. But at the moment, I'm coming at it more from what does it mean for the economy? What's the economic risk? I'm thinking more about tighter financial conditions, the kind of things you can't see right now in public markets.
The idea of how much of this money went to the more peripheral businesses that were more highly levered. If you take a look, how much is this truly just tied to the software story, too? Because about a third of all of these loans, an estimated 1/3, were tied to software companies with increasingly speculative kinds of deal documents, et cetera. So how much is this one particular sleeve, and how much is this going to disseminate between tighter credit conditions at the banks that already are exposed to some of these credit firms?
So much of this stuff is connected right now. Final question. Favourite trade? I know it's difficult to trade this market, but I know you've got a favourite. You've got to advocate for something. What's your favourite trade right now?
Our favourite bounce-back trade would be like the chemicals and materials space in the U.S. I think that's the area that's sold off a ton and should get the most relief if you kind of get energy prices down. There's probably a few stocks in the consumer space as well, but if we had to own something, it'd probably be that chemical space in the U.S.
There we go. Stuart, thank you, sir.
Thank you.
Stuart Kaiser, Citi. You got a favourite trade?
Bed.
I agree.
I mean, at a certain point, you wake up, everything changes. Go back to bed.
I'll take that lie flat on United Airlines. You seen that in coach? The 3 seats that drop. Seen that?
Well, I can tell you, I'm not going to LaGuardia anytime soon.
No, I'm not either.
You're not alone.
I'm not either. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Apple is testing a standalone app for its Siri voice assistant and a new Ask Siri feature as part of a broader AI overhaul. Sources telling us here at Bloomberg the new Siri is designed to tap into personal data and interact with users in a conversational format through text and voice. The upgrade will likely be unveiled in June at Apple's developer conference. And speaking of those lay-flat seats, United Airlines is cutting 5% of its capacity on routes that are not profitable and don't cover higher fuel prices. CEO Scott Kirby speaking to Lisa yesterday about the impact of the war in Iran.
There will be less demand. There'll be fewer people traveling as prices go up. That's part of our cut capacity 5%. Like, when airfares have to go up because of oil prices, there are going to be some people that choose not to fly, and it'd be naive not to realize that. If oil prices stayed where they are today, that's $11 billion of expense for us. And that would require prices to be up 20% to break even.
Kirby adding the airline would have to increase prices by 20% to break even. And ECB President Christine Lagarde signaling the bank is ready to act if surging energy costs create broader bouts of inflation. At the moment, however, policymakers are paused, assessing the global impact caused by the Iran war.
And we will not act before we have sufficient information on the size and persistence of the shock and its propagation. But we will not be paralyzed by hesitation, because our commitment to delivering 2% inflation over the medium term is unconditional.
Lagarde also saying we are prepared, if appropriate, to make changes to our policy at any meeting. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus. Crispin Love of Piper Sandler as stress continues to build in private credit markets. That conversation up next, live from New York City this morning. Good morning.
Access is an issue. When you've got an access issue, prices are high. You're seeing price start to impact demand in Asia because they're feeling the brunt of it. immediately. That's the risk over time, is that availability issue spreads beyond just Asia, moves across the globe. The longer we go, and this, I think, is the key issue.
That was Dan Pickering of Pickering Energy Partners weighing in on the energy issues right now. Live from New York City this morning. Good morning to you all. Equity futures taking their cues off this right now. The move in crude. We're down by 5% on Brent to 99. WTI down to about 88 and negative 4.4% on the session. Off the back of that, you're seeing lower yields, higher equity prices. On the S&P 500 this morning, we are higher, but off session highs, up by 0.75%. On the Nasdaq, up by 0.9. And here's the move in bond yields, just slightly lower after a really volatile 24 hours in the bond market, particularly at the front end of the curve. Two's down about a basis point to 387.91. Going into more supply later on today.
Yeah, we've got $70 billion of 5-year notes being sold at 1 p.m. Eastern today, and we've got $44 billion of 7-year notes tomorrow. How does anybody game out what benchmark yields should be, given the panoply of potential outcomes here? A Fed that has an unclear reaction function and a conflict with unclear outcomes that could potentially transform the world energy market.
Is it tradable? It's always tradable. It's just difficult to trade right now going into the weekend.
It feels like a very tenuous time to take a lot of risk, and it explains why we're seeing such big swings. How much is this on the heels of lighter liquidity, a lighter real conviction that you're seeing in the market?
It's got this Friday deadline, this weekend deadline hanging over this market for the next several days or so, and all these other stories coming out about what the requests are, what the asks are in diplomacy and talks, and if Iran even acknowledges these talks are happening, you're going to have days of this now for the next several days.
It's one thing to have economic data volatility. When you have tweet or truth volatility, it becomes very difficult for people to get ahead of that.
That's the price action and all the volatility. Let's get you some morning calls. First up, Morgan Stanley downgrading Shell to equal weight, reflecting limited upside in the current pricing environment. Your second call from Goldman, lowering its price target on KB Home, noting order slowdowns driven by the Middle East conflict and rising rates. And finally, Wolfe Research upgrading General Motors to outperform, citing a lower tariff burden and improved EV losses. That stock is up by 2% in the pre-market. Let's turn to credit. Concerns continuing to build. Ares and Apollo, the latest to limit withdrawals from private credit funds, blocking more than $1 billion worth of redemptions. Crispin Love of Piper Sandler writing, we believe adhering to the cap appropriately balances the interests of new, existing and redeeming shareholders. Crispin joins us now for more. Krista, good morning. Good to see you.
Thank you, Jonathan.
Thank you very much for being here. Let's just talk about these credit issues and the redemptions specifically. Right. What's behind the redemptions? Who are the people doing the redeeming right now?
Yeah, so the redemptions right now, it's coming from the wealth channel. So it's family offices and it's high net worth individuals who are looking out. And I think a lot of them didn't necessarily know exactly the product they were buying into, where you have this semi-liquid name of the product, and it can be a little bit of a misnomer where it's liquid when you want to get money out and it becomes illiquid when many are running for the exits.
There's another foresight I'd love to get your thoughts on. If it was me and I was redeeming and I knew I'd only get 50% of whatever I was asking for, I'd just ask for double.
Right.
How much of that is happening right now?
It's definitely happening. And that happened a lot in B-REIT a few years ago with Blackstone's real estate fund. So you're definitely seeing that, and where people are asking for more. And one thing on the 5% caps that Apollo, Ares, BlackRock's product has put up, I think that can actually help some of the forward redemptions, where if you're a current investor in that fund and they're letting and the funds are returning more than that 5% limit. If you're in the fund right now, you're thinking, oh, geez, I need to get out now, where I think they're actually doing a prudent thing and using those caps.
Yeah, having the caps really has gotten a lot of attention in the media's eye. What has gotten less attention is how difficult it is to raise money for some of these private credit funds in this environment. How much has that curtailed the raising of new funds?
Right, absolutely. And it's a great question. And I think one thing that we're seeing in the headlines is the redemptions numbers. The requested redemptions were over 11%, but what the headlines aren't talking about are the inflows that came in. So using Apollo, they had gross inflows of about $725 million in this quarter. And what they're going to be paying out is right around $730 million. So net flows in the product are actually relatively stable Who knows what that's going to be in the next couple of months, but it's not as if you're just seeing redemptions and you're not seeing any new capital coming in.
On a broader level, though, I wonder, private credit's been the golden child of the private asset management industry for a number of years now. It outperformed for a couple of years, and then it had more tepid performance numbers. And I just wonder if it really has the same kind of sheen going forward, or if the bloom's off the rose. And frankly, they're not going to have the same kind of power raising money from these family offices as they've had in the past couple of years.
Yeah, no, and I think that's a great point, where private credit is not as attractive right now as it was a couple of years ago, where the environment's changed, where just first base rates have come down, credit quality was extremely strong, and our view is right now is you're going to see credit issues that come up. There are going to be one-offs, there are going to be two-offs, but when you look at the broader portfolio, we don't see systemic issues with many of these companies with loan-to-values at 30 to 40% and EBITDA in the hundreds of millions of dollars. So what we don't think that a lot of people are talking about is private equity, then private credit, where in order for the credit funds to lose money, private equity needs to be completely wiped out.
Getting some headlines on Iran. Just going to jump in with this. You're seeing a bit of a turnaround in the equity market. It was higher by close to 1% on the S&P 500, now positive by just 0.7%. We understand the push, the 15-point peace plan coming from the US side. The Iranian response, they've suggested there is no negotiation right now. This from state media just moments ago. Iran does not accept the ceasefire. The US talks are what they call illogical.
And a lot of the points that the U.S. put out there were the points that were being discussed before the bombing began, before March. And you just wonder, is this really that surprising? The fact that essentially you're saying that the U.S. is trying really hard to secure the ceasefire, and Iran keeps saying, we don't want it. This is an existential battle, and we need to establish deterrence.
This particular news report citing an informed source on the U.S. ceasefire talks. Of course, this is so hard to track, because you don't know who anybody is actually talking about. And when Iran comes out and says this isn't happening, we keep going back to this. I know it sounds like a broken record, but who is Iran? Who is the official? Who are the people we're talking about here? And is that official the person who the US is speaking to right now?
To take that a step further, if you want to go into conspiracy theory land, on one hand, you've got the U.S. and other nations that want to keep oil prices low, and you have Iran that wants to push oil prices as high as possible. So you're going to get the jawboning on both sides trying to achieve those aims, and the market's trading on it.
Crispin, at least you're getting a break. You don't have to talk about these things anymore. Crispin Love there of Piper Sandler. Crispin, thanks for being here.
Thank you,
Appreciate
Jonathan.
it. Otherwise, private markets, as you said repeatedly, this would be the top headline every single morning we're doing this programme if it wasn't for this shock in the Middle East.
It would be a question around how much systemic risk is there, not just when it comes to private credit, but more broadly in the fact that we haven't seen a credit cycle. And in certain pockets, there was lending that wasn't as prudent as has been done in the past, and that there is a shakeup that would be really foisted upon the market should there be some sort of downturn.
The signal this market is taking is that the US is looking for a ceasefire. That's the signal. Those headlines out of Iran also speak to that, and that's where the optimism is coming. And the difference between where we are now compared to where we were first thing Monday morning, which was the prospect of escalation risk, the conversation of a ceasefire is a very different place to be, whether you think these talks have got legs or not.
Which is the reason why the market's a lot more comfortable. Whether it will stay that way, we shall see.
And still positive by 0.8%. Up next, we'll catch up with Senator Dave McCormick from New York City. You're watching Bloomberg TV. Stocks just off session highs. We'll get to the wire in just a moment. Here's the price. We're positive by 0.7% on the S&P, on the Nasdaq up by 0.9. We were higher by more than 1% on the Nasdaq and about 1% higher on the S&P 500. In the bond market, yields were lower across the curve. 2s, 10s, 30s, 2s right now. Almost unchanged, down almost a basis point on 2s to 3.88. And in the commodity market, crude was down by more than 6% at one point. Brent now down 3.9, $100.40. Call it 50. Let's talk about the why. So there's a massive diplomatic push coming from the US side, and hopefully it generates some results. We all want that. You all want to see a ceasefire. You don't want to see any more death, that's for sure, across the Middle East. This is coming from the Iranian side. This according to the semi-official news agency. Iran says the truce and the talks are not viable in the current conditions. That's the pushback coming from the Iranian side.
Yeah, saying that the U.S. talks are illogical, according to the semi-official state media. And it raises this issue of, can you get confidence in the signal coming from the White House that they are efforting some sort of diplomatic solution? Or is the reality something that is a protracted battle where both sides are gearing up for a longer situation? And ultimately, the market is going with the more optimistic view, at least for the moment.
It's clinging to the signal for now that this is an administration looking for talks. But you have to keep your eye on the horizon. And that's what makes this market so difficult to trade right now. Most people acknowledge that. We've said this repeatedly throughout this morning. We're confronting substantial two-way risk. This can break one way or the other. And it's the other way it can break that I think we have to spend some more time on. Look at the calendar and look where we'll be by the time we get to this weekend. There's a potential for a real troop build-up in the Middle East in the next several days. That puts us in a very, very different position, facing a very, very different scenario. And choosing what to weight, one versus the other right now, is a huge judgment call you've got operating in this market.
Which is the reason why people are pointing to that troop buildup. Initially 5,000 troops sent to the region, then an additional 2,000 from this special unit that is known to be called up quickly and go in. It raises for Iran a question of whether the U.S. is delaying in order to make a bigger incursion on land, with boots on the ground. This is the reason why this is such a difficult conflict.
The S&P giving up some gains, still just about positive by 0.5% with the opening bell just around the corner. Let's get you some morning movers, your single names with Yahara. Hey, Yahara.
Hi, John. After a sharp sell-off in software stocks yesterday on reports Amazon is developing new AI tools, I want to show you this name, Braze, surging 20%. This is a software company, one of the top performers on the NASDAQ in the pre-market. And bucking those disruption fears due to its earnings, with the company pointing to strong demand, including strong enterprise bookings, up 50% year on year. And turning to the Mag 7, we are still seeing resilience despite those headlines we just got that you just broke on Iran not accepting this ceasefire, as investors continue to lean into this idea that President Trump is trying to de-escalate, trying to have a ceasefire. So you are seeing Tesla, Nvidia, Amazon all still up in the pre-market. And we end on AMD and Intel also showing some resilience. Intel up 3.6% on reports from Nikkei that both companies are warning customers about another round of price hikes for their CPUs. It's the latest sign that the chip shortage is moving beyond just memory and into processors, and that's adding pressure on PC, server, and smartphone makers as they compete with data centers trying to get those memory and CPU chips. John?
Yahara, thank you. Thanks for the update. Let's turn back to our top story. The Iranian semi-official media just moments ago saying Iran does not accept a ceasefire proposal from the United States. The US proposing a 15-point plan to formally end the war between the two nations. Annmarie is joining us now from Washington, D.C. and joins us with a special guest. Hey, Annmarie.
Thank you so much, Jonathan. Yeah, the Iranians are saying that these talks are illogical, and a man that sits really at the center, the intersection of all of this, his experience now and prior experience, whether it's geopolitics, financial markets, or actually a decorated combat veteran. I am joined now by Senator David McCormick from Pennsylvania. Senator, thank you so much for joining me, and good morning to you.
Good morning.
So I'm not sure if you just saw the news, but Iran is saying that these ceasefire talks are non-existent, and they're calling what the U.S. is calling for as illogical. What is your understanding right now what the White House is putting forward? You sit on the Senate Foreign Relations Committee. Is the president buying time? Is this diplomacy or is this a distraction?
Well, I wouldn't put much stock into what the Iranian spokesman say. Think about it this way. If you're the person that's trying to negotiate some sort of end game and you've got a bunch of radicals as part of the constellation of forces in Iran, you're certainly not going to present yourself as the voice of reason. So a lot of what's happening, I think, in the public domain shouldn't give us too much insight into what's happening behind the scenes. I think stepping back, bottom line, if you would have said on the first day of combat operations, where will we be 20, 21 days, 22 days into this, I think from a military perspective, we've made enormous progress. We still have work to do, but we've eliminated ballistic missiles, drones, manufacturing capability, the Navy. And those are the goals that President Trump set out, along with making sure Iran can never get a nuclear weapon. So question one for America, I think, is where are we relative to those goals? I think we've made a lot of progress, but we got to finish that job. And then second, we've got to make sure we secure the Straits of Hormuz. And I think there's multiple ways to try to lessen the blow on oil markets. One, the administration is doing a lot of things to make sure there's adequate supply. But inevitably, we're going to have to be able to show the markets and show the world that we can put ships through the straits. And that's going to require some combination of our allies working together with our military to eliminate that threat. Once those two things happen, I think we have a much more stable, secure situation. And I think we're on a path to being able to look back and saying we've achieved the objectives there. But obviously, there's more work to do.
Well, could that happen through this 15-point plan the administration has given the Iranians via Pakistani officials?
Yeah, I think it could. I mean, the most important goal of the United States, and it was the goal from day one, this was a regime that was underwriting terrorist organizations around the world. It had more American blood on its hands than any other country. It was building up an enormous ballistic missile capability. If you think Iran was formidable today, imagine 3 years from now. It had called America the great Satan that it wanted to destroy, and it was committed to a nuclear weapon. That was an unsustainable position. We had to eliminate that threat. If that threat is eliminated and the Iranian regime, whatever form it takes, is committed to not rebuilding nuclear weapons and not restarting its ballistic missile, then that's the basis for a negotiation. The Straits of Hormuz. This is. I laugh when I hear people saying maybe they didn't think of that. I mean, this has been the strategic question for decades. When I deployed to the Gulf in 1990, this was a primary consideration. Oil prices were over $100 in today's dollars. And in the financial crisis, when I was the Undersecretary for the Treasury, oil prices hit $200 in today's prices. So creating stability in the Straits and making sure it's secure is a critical geopolitical objective. And we're going to have to we can't leave this situation until we're sure the Straits are going to be secure. And certainly, Iran as a military threat is going to be dramatically diminished, which was the goal.
Well, I want to pick up on your past. Your old division, the 82nd Airborne, is being deployed, 2,000 troops. Is it your understanding that those service members, along with the 2 Marine expeditionary units, will be used to secure the Strait?
I think the president's doing exactly what he should do, which is he's creating maximum optionality. Those forces in the region, relatively small numbers, 5,000 or 6,000 in total, once the 82nd gets there, they just give him lots of optionality. There's all sorts of potential ways that you might use the combination of air power, naval power, and ground troops to secure the Straits. So I think the president's smart to create options. And he's made the objectives clear, which is we got to get rid of this military capacity to kill Americans, threaten our allies, and we've got to have the Straits secure and open to global commerce. Those two things are critical. I also want to make a point that if you look at this situation compared to those past situations, 2008 that I mentioned or 1990, what's different is the commitment to energy dominance that we have here in America. And I give President Trump a lot of credit for that. We're a net exporter. We are well on the way to building enormous capacity based on the steps the president has taken. So we are more isolated from the shock associated with what's going on in the Middle East than we've ever been in the past. And others, China and Europe and others, are not as isolated because they haven't had that kind of capability and leadership that we have in the United States.
Of course, your former job, our audience knows you very well. You ran Bridgewater Associates, this massive hedge fund. I just would also love to get your take in terms of what's going on with financial markets. Energy prices have been whipsawing. We're seeing trading ranges you would normally see in a year, even 2 years, that are happening within moments, especially most recently regarding what's happening in the oil futures moment. Do you understand exactly what is going on in terms of the financial markets? Do you think they're paying too close attention to potentially what Trump says and not exactly what he's doing?
Well, listen, I wouldn't be one to want to stand here and try to predict markets, but I do think if you look through this moment, so look weeks, months ahead, and don't get caught up in the day-to-day whipsawing, I think you can see a path to a circumstance where energy markets more broadly and American interests more specifically are in a much better situation than they were before the president took action in Venezuela and in Iran. So imagine a world where Iran no longer has the capacity to threaten the Straits. The Straits are open, and so we have that constant supply that goes through there with security. 30% of the oil reserves in the world are in Venezuela and Iran, and those certainly Venezuela, but hopefully Iran will be much more amenable, pro-Western when the dust settles. I'm not trying to be too Pollyannish here, but if you think through the path of what we might see in 3 months, 6 months, I think it's a much more stable world. I think it's a much more stable Middle East. I think the Straits of Hormuz are more secure than they were before this started. And I think global oil markets and global energy markets are much more stable. And again, I want to come back to this. This happens within the context of America Energy and Pennsylvania Energy. We're the second largest energy producer in America. We're the fourth largest natural gas reserves in the world. We're unlocking that potential. So I would imagine, again, when the dust settles, that Europe will be a much bigger buyer and recipient of American energy because they've now seen some of the uncertainty that goes with having Russia as a supplier or the Middle East as a supplier. So I think there is a...
So, Senator, just specifically on the oil futures market, there was a massive trade just minutes before the president's truth came out. And we've had guests on this program, some of your former colleagues in your old world, saying that is highly suspicious at minimum. Didn't want to go far to say it's manipulation. But are you concerned that there has been manipulation when it comes to some of the posts or statements we're seeing from the White House and massive trades taken just before those moments?
Well, in general, without going specific to that, in general, I'm concerned about the fact that that information can be leaked in a way out of the government or to public officials in a way that people benefit from, whether it's public officials or otherwise. I just co-sponsored a piece of legislation to eliminate the ability of members of Congress to trade equities. Not because I think there's massive fraud going on or something like that, but because even the perception of people benefiting from insider information that resides within the government, I think is extremely problematic. So I can't comment on the specifics of those trades, but what I will comment on is I think there's a clear set of rules and laws that everybody needs to adhere to if you're in public life. And then second, we also need to worry about the perceptions associated with that and take the extra mile to make sure that the public can be confident that that public officials are acting solely in the interest of the public.
We hear a lot, and I've been hearing a lot, how the physical market is so different right now than the paper market when it comes to energy. You mentioned what is going on in terms of how America really is a net exporter now, so we are a little bit more insulated from this. But still, I'm sure you've heard from constituents, prices are going up. Gasoline is a hair away from $4 a gallon. How is Congress set to address this?
Yeah, I'm glad you mentioned that. It's I should have mentioned that. That's a huge issue that's happening on the ground in Pennsylvania. The gallon of gas is about 60 cents more than it was before this started. And if you're a working family, the median income in Pennsylvania is about $52,000 a year. If you're a working family, this puts real pressure on you. And so, we've made enormous progress since the president took office on bringing down the rate of inflation to about 2.5. It was on average 5 during the Biden administration, 22% total, and wages up. So wages are greater than inflation, but people are still feeling pressures from housing costs, from healthcare costs, and from energy prices. And so there's a number of things we're trying to do. The president just sat down with a number of the governors from the PJM states in the Northeast to try to bring down electricity prices. These deals that are being done with the hyperscalers for the big data centers, we're a big recipient of that investment. They're now being done with a covenant that essentially ensures that they bring energy that exceeds what their demand's going to be, so it doesn't raise energy prices for folks. So there's a number of things underway, permitting reform to bring down the price of energy. But in the near term, I take your point, and it's a very real one. People are feeling this pressure, and that's, I think, one of the reasons we hope to get this thing wrapped up in the coming weeks so we can have that stability and get these price increases behind us and go back to normal.
And some of our viewers, of course, might be, and I just want to end on this, might be going to the airport today, and I'm sure you've seen the lines, some of them up to 5 hours long. What is going on with funding DHS? You know, there's lots of reporting that there is this GOP bill, potentially, where we could fund DHS, but it wouldn't go to ICE enforcement. Would you be a yes on that?
Well, listen, and I hope you help me be back to my program where you can test this sometime down the road if this ever happens. But whether I'm a Republican or a Democrat, in the majority or the minority, I will never vote to defund the government or not fund the government. This is it's a real disgrace. And this is the second time it happened. And what happens is the Democrats are trying to use this as political leverage to get reforms in ICE. And the people that are suffering are the members of TSA or the Coast Guard, the Secret Service, CISA, which is the Homeland Security Cyber Office. The bottom line here is this is creating additional risk for Americans because the threat level's up based on what's going on in the Middle East. It's a huge burden on those TSA agents. We've got a call-in rate in Philadelphia of about 25%. So 25% of people aren't coming to work. They have to go earn money elsewhere. And it's a huge burden. I flew on Monday. It was a disaster. I had flights canceled. I sat on the runway. It was a 6-hour trip that took 14 hours.
So sounds like you're a yes.
I am a yes.
Sounds like you're a yes?
We've got to fund the government. Absolutely. We've got to fund Homeland Security. The reforms that the Democrats are talking about, many of them were already in the bill. Body cams, money for de-escalation training. The president already put forward a set of reforms. This is political theater. This is not good policy, and we got to get it behind us. I think the American people are rightly incredibly frustrated, as am I. I'm a yes.
Senator Dave McCormick, thank you for your time. And, of course, this conversation focused on Iran. Thank you for your service in the 90s. Jonathan, of course, that was a senator from Pennsylvania. He's a yes when it comes to funding DHS. And the question was not for ICE enforcement. When it comes to Iran, he said the job's not done. Interesting take.
Annmarie, appreciate the update. Fantastic exchange. Senator McCormick, uniquely positioned to talk about these issues. Experience with policy, experience in financial markets, experience in the military as well. On Monday morning's price action, I really liked how he framed this. This is important. Who knew what and when? It's not proven that anything nefarious happened, but the activity in the lead up to that social media post is raising lots of questions. And the perception, just the perception of people benefiting, is a problem in and of itself.
That's the reason why he's backing things to prevent certain types of trading in Congress more broadly. But it goes to the bigger question, how confident can people be investing in a market that feels rigged on some level? And that, I think, is something that people will increasingly discuss, even if nobody can prove a thing. And even if it isn't necessarily anything nefarious, the perception is there, and that's a problem.
His line on Iran is really important as well, and we've talked about this in various ways throughout the last few days. When you get denial and pushback from the Iranian side, even if you were negotiating, would you want to talk about it publicly? Would you like to tell your other friends in Iran that you're having those conversations with the US right now about securing some kind of peace deal?
Just this adds to the question around market dynamics right now as well, because the U.S. would like to see oil prices come in and they would like a sense of stability. And Iran wants oil prices to go up and have the perception that this is an existential battle, that they will act like cornered cats and keep fighting and keep doing moves, however desperate, to make sure that this is a disruption that exerts the maximum pain on the international economy.
It's a battle to secure leverage right now, and getting visibility on these talks increasingly difficult. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Iranian officials rejecting the U.S.'s 15-point peace plan a day after receiving the offer. State media saying Iran does not believe it is logical to enter talks with parties that violate agreements, acknowledging the U.S. has stepped up efforts to secure a ceasefire with indirect talks. Meanwhile, Barclays shares are rising 3% in London. The bank is scaling back its asset-backed lending to smaller borrowers. The move follows losses Barclays suffered from the collapse of financial solutions and Tricolor Holdings. Barclays is shifting its focus to loans for larger corporates, already pulling back from several deals with higher perceived risks. And SpaceX could file for its highly anticipated IPO as early as this week. The information reporting Elon Musk's company may try to raise a record of more than $75 billion. That would make it the largest in history, topping Saudi Aramco's more than $29 billion listing back in 2019. That's your Bloomberg Brief. John?
What a time. What a time to deliver. And Yahara, thank you. What a time to deliver. One of the biggest IPOs ever.
I mean, this to me shows how financial conditions are not that tight, right? I mean, we've all been talking about tightening financial conditions, but that IPO, which might be the biggest or one of the biggest ever in history, still potentially slated for this week.
I think it's fair to say that's a particularly unique company that might get some particularly unique attention.
There are a lot of unique companies, though, and this is the reason why people keep saying you could still increase maybe your forecast for U.S. equities.
Yeah, Barclays. What a call from Barclays to lift your price target on this stock market. Amazing. At this moment. Up next on the programme, we'll set you up for the day ahead from New York City this morning. Good morning. You're watching Bloomberg TV.
The most likely path is the uncertainty in the Middle East may put them on hold for a while, but I think eventually this will be resolved. It'll be in the rearview mirror, and I think at that point, Kevin Warsh, when he does arrive, will be inclined to lower rates at least down to the neutral level of around 3%.
Could be an interesting summer for the Federal Reserve. That was Richard Clarida of PIMCO, formerly, of course, the Fed Vice Chair. Not so long ago. If you're just joining us, welcome to the programme. Equity futures right now in the S&P 500 positive by 0.8%. On the S&P, on the Nasdaq, up by 1%. On the Russell, also higher by 1 percentage point, with the opening bell just around the corner. Bond yields set up as follows: 2s, 10s and 30s. Yields are just a little bit lower by a basis point on 2s, with crude down on the session. Going into some important auctions, Bramo, over the next few days.
$70 billion of 5-year notes coming later today. And then, of course, on tomorrow, you get $44 billion of 7-year notes. Do you get the same kind of indigestion that we got yesterday with the 2-year auction? And if you do, what does that say about people's appetite to absorb interest rate risk at a time of such volatility?
It is a very interesting market. I think we can say that right now, right? It's a very confusing time. Difficult to really put money to work, but a very interesting market.
I think that is completely believed across Wall Street.
From New York City this morning, good morning. This was Bloomberg Surveillance.